everyone, my name is Afreen Azmat and I welcome you all in today's session. So today is actually a very important video for all of you, and this video is indeed very special for all you bankers. Why? Because I am going to cover all modules A, B, C, D in this one video. So this video is very beneficial for your exams. Not only conceptual clarity, you will get some practice questions also, which helps you to clear your examination. Thank you so much, everyone. So just watch this video and enjoy. Discuss, and we are going to start module C for Indian economy and Indian financial system. This is Unit 20 IEFS Module C and Indian financial system, and overview of the Indian financial system. Okay, so let's start discussing this chapter. Everyone who is watching this session, it's request just please like and share the video to the maximum you can. Everyone, guys, if you are watching this session, it's a request that please like and share the video to the maximum you can. Okay, so let's start discussing this topic. First is the phases of development of Indian financial system. So if we are talking about the phases of the development of Indian financial system, see, we have four phases. Okay, so we have four phases. The development of the financial system in India can be divided or distributed into four different phases. Now, what are these four different phases? So first is the pre-independence phase one, right? So pre-independence, it is actually before 1947. It is actually prior to 1957. This is important. You have to learn the dates also, right? So pre-independence, it is before 1947. Then it is post-independence. Post-independence, after independence, it is from 1947 to 1991. Okay, then it is post liberalization. Post liberalization means from 1991 to 2010, and then it is post global financial crisis phase. So, world faced the worst global financial crisis in 2010 or 2008 to be very precise. So, the post globalization financial crisis phase, and that is 2010 to present, right? So, we are in this post global financial crisis phase. Okay, so let's start discussing these phases. So the most important things that happen in these phases. So let's talk about the phase one. Now it means pre-independence phase. Okay, pre-independence means phase means before 1947 phase. Okay. Now, before 1947 phase, if we talk about, there was establishment of Bank of Hindustan. Okay, so Bank of Hindustan, it was established in 1770, and it was the first bank in India. Okay, but it was not an Indian bank. Actually, it was a European bank which was set up by Alexander and Mazur Company. So Alexander and Mazur Company has set up this bank, Bank of Hindustan, in 1770 in Calcutta. Okay, but unfortunately, this bank doesn't have so much. Okay, and that bank fails and discontinues its services in 1832. Right now, second most important thing that happened in this phase is the three presidency bank. Right now, Three Presidency Bank was established before 1947, and that was Bank of Calcutta in 1806. Bank of Calcutta, it was established in 1806. Bank of Bombay, it was established in 1840, and Bank of Madras, it was established in 1843. So, Bank of Calcutta, Bank of Bombay, and Bank of Madras, it was established before 1947, right? Now, these three presidency banks were merged into Imperial Bank of India in 1921. Okay, and after 1947, it has been converted to State Bank of India by the committee's recommendation, which was known as Gorwala Committee recommendation. Okay, it was known as Gorwala Committee recommendation. So 1955, Interior Bank of India has been nationalized and converted, and the name has been renamed to State Bank of India. So if the question is asked, the State Bank of India started from which bank? So it has the back roots from Bank of Calcutta. So Bank of Calcutta, Bombay and Madras, then Imperial Bank of India, and then it is the State Bank of India. So this was done after 1947, but I have given you explanation here so that you can remember. Okay, next. Now this before 1947 there were different banks also, or therefore different establishment also. If we are talking about now, what are these different establishments? First, during this phase, if we talk about in this phase the Bombay Stock Exchange. Okay, so Bombay Stock Exchange has been established in 1875, and it was Asia's first stock exchange. Bombay Stock Exchange, it was established in 1875, and it was Asia's first stock exchange, right? Now, second, pre-independence phase. Now, pre-independence, this phase, it was around 1920s, where there was extreme turbulence in the financial market. There was extreme turbulence in the financial market, which led to the closing down of the number of banks, which led to the closing down of number of banks. Approximately, if I'm giving you a number, 588 banks were closed down during this time period. Okay, and this was a very big shock to the Indian financial industry, and this actually gave us the need that we have to establish a banking regulator, because there was no regulator at that time. Every bank was doing everything at their own, and so that circumstance was responsible for the failure of this extreme banks in India. And then after this 1920s failures, the setting up of a Reserve Bank of India, means the regulator of all the financial system, it was recommended by Hilton Young Commission. So Hilton Young Commission, I think they gave the recommendation in 1927, right? And after the recommendation, it was established in 1935, Reserve Bank of India, and the act has been passed in 1934. So these were the things which you have to remember. Okay, just check this year. I just forget this year. Okay, Hilton Young Commission. Okay, next. Now phase two. Let's discuss about the phase second. Now post-independence phase. Okay, so this was from 1947 to 1991. This was from 1947 to 1991. Now this phase actually started with the nationalization of Reserve Bank of India. This was started with the nationalization of Reserve Bank of India, and the nationalization has been done in 1948. Okay, next, the nationalization of State Bank of India is done in 1955. The same thing, three presidency bank merged into Imperial Bank of India and converted to State Bank of India in 1955. And State Bank of India, this was actually recommended by the Gorwala Committee's recommendation. So always remember this Gorwala Committee recommendation. The question can be asked from here, right? Now, if we talk about the succeeding years, in the coming years, 1956, September 1, 1956, 245 private insurance companies were nationalized to find the or to form the Life Insurance Corporation of India. So there was the Life Insurance Corporation of India, which has been formed. Okay, so in the succeeding year, on September 1st, 1956, 245 private insurance companies were nationalized, and these after nationalization formed the Life Insurance Corporation of India. Okay, the government nationalized the largest 14 private banks on 1969. Okay, this was again a very important thing, very important, you have to remember this. Okay, so, if we talk about the government, okay, so the government nationalized the largest 14 private banks. Okay, so 14 private banks were there, and the government announced that whichever bank has the total deposit of over and above 50 crores, they need to be nationalized. Nationalized means they need to be converted into a private sector bank. So, In 1969, July 1969, whichever banks have the total deposit of 50 crores and above, they were nationalized. Okay, and there was 14 private banks who have the nationalized, who have over and above the deposits on over and above for 50 crore, and they were nationalized at that time. Okay, then there was the socialized banking sector. Okay, and in 1980, again 16th April 1980, again. Okay, so approximately six banks were nationalized again. Okay, now six banks who have the total deposit of exceeding 200 crores. So they were again nationalized in they were again nationalized during 1980. Clear? Now, next, if we talk about the names, so these are the names of the 1969 and 1980 batches, okay, or banks, okay, which were nationalized. So 1969 and 1980 banks, which were nationalized at that time. Okay, so let's discuss about the name. Like 14 banks were Allahabad Bank, Bank of Baroda, Bank of India, Bank of Maharashtra, there was Canara Bank, Central Bank of India, Syndicate Bank, UCO Bank, United Bank of India, Union Bank, Punjab National Bank, Indian Overseas Bank, Indian Bank, Dena Bank. These were the banks which were nationalized in 1969. And during 1980, there was Andhra Bank, Corporation Bank, Punjab and Sindh Bank, Vijaya Bank, Oriental Bank of Commerce, and New Bank of India. So these were nationalized during 1980. Okay. Now, in the phase second, there was a major steps that has been taken for the development of rural banking system also, and to promote the financial inclusion means connecting various people to the banking sector, right? And for this, there was the regional rural bank which was set up in 1975, 2nd October 1975. The first regional rural bank which was established, and the name was Pratham Gramin Bank. The first regional rural bank which was established, and the name was Pratham Gramin Bank, and there also been set up. And then if we talk about the next thing, there the Industrial Finance Corporation of India, means IFCI, has also been established in 1948. So IFCI, this is also established in what, 1948. The Development Financial Institution, this also been set up, right? So these were the things that were have been set up during the second phase. Okay, second phase of Indian financial system. Okay, so actually, module C, if I'm talking about the module C, right? Module C is completely based on facts. Okay, so there was very simple. This module C is very easy, very scoring module, right? Because see, module B, you have to learn a lot of things, you have to memorize a lot of things, right? But in module C, you just have to learn the facts. Okay, in module B, you will find more of concepts and what is national income, GDP and budget and everything. But here you will find more of facts, so you have to learn these, that RRB was established in 1975, the Development Financial Institution has been established. Okay, there was Industrial Finance Corporation of India, which has been established in 1948. Clear? Okay, done. Okay, next. Now, if we talk about this second phase, okay, so this second phase, there was a major step that has been taken, and it was the Regional Rural Bank that has been set up in 1975. Okay, now the Development Financial Institution and IFCI has been established in 1948. That I have already told you. Now, here also remember this, that Industrial Development Bank of India, this also been established in 1964, Industrial Development Bank of India, and NABARD, National Bank for Agriculture and Rural Development, this also been set up in 1982. National Housing Bank, this was set up in 1988, and Small Industrial Development Bank of India, Small Industrial Development Bank of India was set up in 1990. Clear? So regional rural banks, if we talk about the regional rural bank, it was set up by the recommendation of Narasimha Committee. Remember, this was set up with the recommendation of Narasimha Committee, right? And if we talk about this, Okay, if we talk about the NABARD was established with the recommendation of Shiv Raman Committee. These committees were important. Okay, so you have to remember the name Shiv Raman Committee or Narasimha Committee. Okay, next. Phase third. Now let's discuss about the phase third. Now phase third is from 1991 to 2010. Phase third is from 1991 to 2000. Now in this phase, the two very important committees have recommended some of the very important things. Like there was Narasimha Committee Phase 1 1991. There was Narasimha Committee Phase 2nd that has been started in 1998. Okay, so if we talk about the Narasimha Committee Phase 1, the recommendation, the important recommendation of Narasimha Committee Phase 1 was lowering the statutory liquidity ratio, cash reserve ratio. There was achievement of 8% capital adequacy ratio. There was interest rate that should be allowed to determine by the market forces. What is market forces? Market forces means demand and supply. What is market forces? Market forces means the demand and the supply. Clear? Now, if we talk about the competition, so there was some competitions that were coming from the new private sector banks. So there should be a freedom of operation that should be given to the public as well as the private sector's banks. So these were the recommendation during the Narasimha Committee Phase 1, 1991. Okay, now second phase 1992, the most important recommendations were the strengthening of the banks in India. So whatever the banks banking system were working in India, you have to strengthen the banking system in India. You have to follow the narrow banking, plus you have to review all the banking laws. So these were the recommendation of phase 1 and 2nd. Very important is this year. You have to remember this year. First phase 1991 and second is 1998. Okay, next phase 4, post global financial crisis. Post global financial crisis, it was from 2010 to present. Post global financial crisis, it was from 2010 to present, right? Now if we talk about the global financial crisis of 2007 and 8, the global financial crisis of 2007 and 8 was started by the United States. So it was started in United States, and thereafter it was extended to the rest of the world. Now, the problems that there was a lot of insolvency of different banks because they were lending without due diligence. There were frauds happening in the banking system. There was different type of frauds that happened in the banking system, and due to that, the world goes in the global financial crisis, which actually started from USA. Right now, for strengthening these, there was different financial inclusion drives which was introduced by the Prime Minister or by India's government. Like there was Jan Dhan Yojana, Pradhan Mantri Jan Dhan Yojana, Prime Minister Jan Dhan Yojana. There was JAM Trinity, Jan Dhan, Aadhaar, and Mobile. So these were the different type of government scheme that has been opened for what? For financial inclusion, for just connecting maximum people to the banking system of the economy, right? Now, in this time period, there was different license that has been given to the differentiated bank. There was different payment bank, small finance bank. These were started during this phase, right? So license. So there was different new payment banks were started in this phase. Small finance banks started in this phase. Very important in this phase, PJ Nayak committee has been established, which was officially known as a committee to review governance of board of bank in India. Okay, and it was started by Reserve Bank of India in 2014. And what was the purpose behind starting this committee was to review the governance of the board of bank in India. It was actually for the review of the governance of the board in India. Clear? So this was the phase, right? So we have learned about the 4 phases. I'm just telling you a revision, a quick revision. So I have told you that phase 1, we have a lot of things happening, right? And phase 1, very important. So most of the questions you are expecting in your examination is actually from phase one, right? So always remember this phase one is very important. You have to learn. There was a lot of things that you have to learn in this phase one. Okay. Now phase two, if we talk about the phase two, yes, the pre-independence. Now there was different things that happening in the phase one before independence. BSc has started. The failures of bank has been done. Now phase two, again a very important thing. Now you have to learn about the nationalization and RBI and SBI. These were the nationalization that you have to learn here. The nationalization of 14 private banks, the nationalization of 6 private banks, these you have to learn, right? Now, post independence, if we talk about these phases, in this you have to learn that the first regional rural bank has been established, right? The Pratham Gramin Bank has been established here. So, this you have to clear. Because unit 21, that is Indian banking structure. This is this is IEFS module C. So everyone who is watching this session, kindly please like and share the video to the maximum you can. Everyone guys, just please like and share the video to the maximum you can. Hi guys, just please confirm once about the audio and video of the class. Is everything is good, working fine? Is everything is good, working fine? No issues, right? So let's start the session. So let's start this session. Let's talk about the Indian banking structure. Okay, the important thing related to Indian banking structure. First of all, if we talk about what is banking, so first is what is banking. Okay, so banking is actually defined in the Banking Regulation Act 1949, and banking is defined as Section 51 in Section 51B Banking Regulation Act. And it is what? It is actually the acceptance of the deposit from the public. It is actually acceptance of deposits of money from the public for the purpose of lending or investment. So this is known as banking. So banking has two major things. Banking has what? Two major things. First of all, it actually accepts deposit from the public. Okay, it actually what? Accepts deposit from the public. And this acceptance of deposit is actually what? It is actually for the purpose of lending and investment. It is actually for the purpose of lending and investment in the market. Then it is known as banking. It is what known as banking. Clear? Now let's talk about the history of banking in India. So we have already discussed in the last previous session the four phases of Indian financial system, right? If you all remember the four phases of Indian financial system, we have discussed the four phases of Indian financial system. Let's talk about the history of banking in India. So if we talk about the history of banking in India, it was begin with the Bank of Hindustan. Establishment of Bank of Hindustan. Bank of Hindustan was the very first bank in India, right? So it was the first bank, but yes, it was not an Indian bank. It was the European bank, which was set up by Alexander and Nasser Company, right? This Bank of Hindustan, this was actually established in 1770, and it was established in Calcutta. And the name of company was Alexander and Nasser Company, right? And they marked the starting of the formal Indian financial system in India. But this bank didn't work quite well because after 1770 establishment, it was discontinued in 1832. But then, after the emergence of Hindustan Bank, there was different banks that has been introduced. Like there was General Bank of India, which has been established, Oud Commercial Bank established. Okay, and these bank also not able to continue for a very long period of time because see, we don't have much important regulators to handle these banks. So, in the initial days or in the first phase of the financial system, it was quite not possible for each and every bank to work, okay, in a very good condition, and that's why these banks were discontinued in the initial phase. These banks were discontinued, right? Now, if we talk about the things that Bank of Calcutta has been established in 1806. Bank of Bombay, it was established in 1840, and Bank of Madras, it was established in 1843. These three banks were merged into Imperial Bank of India in 1921. These three banks were merged into Imperial Bank of
India 1921, and the Imperial Bank of India after the Gorwala Committee's recommendation. Okay, it has been nationalized and converted to the name which is known as State Bank of India. Now, State Bank of India. Now, what is nationalization? First of all, if we talk about the nationalization, nationalization means when we convert the public bank into, sorry, private bank into public bank, means when in the private bank, the government of India taking the control of the private bank, the government of India buying the maximum share in the private bank, then it is known as what? It is known as the, what? It is known as the, okay, or it is known as nationalization, right? So Imperial Bank of India, after the recommendation of board committees, it was converted into State Bank of India. If we talk about the next thing, yes, during the initial phase and during this time period, 10 years time period, we have known that we have seen an extreme turbulence in the Indian financial system, which actually leads to the closing of different banks. Okay, now there was different banks which has been closed, approximately 588 bank, I have told you, right? So these banks were closed during the initial stage. The main thing why these banks were closed at that time, because there was no regulator in the banking system. So every bank was doing their own thing. They are following their own terms and condition, and that's why the banking were not in a very good condition. The banking structure was not in a very good condition, and these banks were what? These banks were uh, shattered during this 10-year time period, and this breakdown leads to the establishment of a banking regulator. And then the central bank, means the Reserve Bank of India, was set up in India by the recommendation of Hilton Young Commission. Hilton Young Commission recommended the establishment of central bank, Reserve Bank of India, in 1927. Okay, then Reserve Bank of India Act passed in 1934, and Reserve Bank of India established in 1930. Right now, in order to achieve a more monopoly in the banking area, so government want to dominate the sector, and that's why government want to have the control of more and more resources over them. So they want to have a domination in various resources. So at the initial stage, we have a lot of private banks. So the government of India wants to have more control over the banking system, and so the government of India took two major steps here. Indira Gandhi was the prime minister, so she announces that whoever in 1969, whoever bank has the total deposit of over and above 50 crores, they will be nationalized. So in that time period, 14 banks have the deposit of over and above 50 crores, and so these banks were nationalized, right? And if we talk about the other private sector bank, yes, there was nationalization done in the other private banks also. So there was nationalization of six private bank has been done in 1980. These banks have the total deposits of 200 crore and above. Okay, so these are the important things. So nationalization, if we talk about the nationalization, this is very important. Okay, so nationalization, first of all, 1969, it was for 16 banks and if 14 banks, and it has the total deposit of more than 50 crores. Okay, and in 1980 it was approximately of six banks with a total deposits of 200 crore and above. Right, clear? Okay, done everyone? Nice. Next thing, important legislation that is affecting the establishment of banks. So there are important legislation which are actually for the establishment of banks. So there are different acts governing the bank, right? So these are the acts, these you have to learn, especially you have to learn the year, in which year these act have been passed, right? So Reserve Bank of India Act was passed in 1934. There was Banking Regulation Act passed in 1949. There was Reserve State Bank of India Act 1955, there was State Bank of India Act 1959, there was Deposit Insurance and Credit Guarantee Corporation Act 1961, there was Banking Companies Act 1970, there was Banking Companies Act 1980, there was State Bank Act 2018. So these were the act. You just have to remember the year relating to these. Okay, the year is very important. Year is very important. Okay, next. Now, what are the types of banks? So if we talk about the types of bank, there are two major type of banks. One is scheduled and one is non-scheduled. So the very basic of the scheduled and non-scheduled bank. So with the very basic of the scheduled and non-scheduled bank is, scheduled bank are those bank which are included in the second schedule of RBI Act 1934. So if any bank is registered under or scheduled under second schedule of RBI Act 1934, these are known as scheduled bank, and these banks should have a paid up capitals and fund of at least 5 lakh in order to qualify as a scheduled bank, right? What are non-scheduled bank? Non-scheduled bank are those banks, these are written as those banks, who are not listed under second schedule of RBI Act 1934. So those banks which are not listed under second schedule of RBI Act 1934, they are considered as non-scheduled bank, and non-scheduled bank, they can borrow from RBI only in the events of emergencies. Okay, whereas the scheduled bank can borrow from RBI for their day-to-day operations also. The minimum capital requirement for a non-scheduled bank is governed by Section 11(1) of Banking Regulation Act 1949, whereas the capital requirement for the scheduled banks are actually governed by Section 42(6) of Reserve Bank of India Act 1930. So these are the scheduled and non-scheduled. Clear? Now, if we talk about the public sector bank, okay, kindly everyone who is watching this session, okay, please just like and share the video to the maximum you can. Everyone, whoever has joined this session, just please, it's a request, guys, that please like and share the video to the maximum you can. Everyone, guys. Okay, so if we talk about the scheduled commercial bank, now there are scheduled commercial bank and scheduled commercial bank. There are public sector bank also, private banks also. So let's discuss about the public sector bank, private banks, etc. So public sector banks actually comprises of State Bank of India. Public sector bank actually comprises of State Bank of India, and presently there are 11 nationalized banks which are under the public sector bank, right? And these are actually by the Acquisition and Transfer of Undertaking Act of 1970 and 1980. If we talk about the State Bank of India, State Bank of India earlier has 7 subsidiaries which were constituted under the State Bank of India Subsidiary Bank Act 1959. And these were later, after the merger, known as Associate Banks of State Bank of India. Then in 2008, there was State Bank of Saurashtra and State Bank of Indore, which was merged into SBI, State Bank of India. And there was other subsidiaries like State Bank of Hyderabad, Patiala, State Bank of Travancore, State Bank of Mysore, and State Bank of Bikaner and Jaipur. These were merged with SBI, State Bank of India, in 2017. These were merged into State Bank of India in 2017. Clear? Now, these were the anchors bank and the public sector undertaking banks which were merged. So if we talk about the merger, Orient Bank of Commerce and United Bank of India, these were merged into PNB, Punjab National Bank. Allahabad Bank, it was merged into Indian Bank. Syndicate Bank, it was merged into Canara Bank. Corporation and Andhra Bank merged into Union Bank of India. As well as there was two bank, if in the economy it was Dena Bank, and there was one more bank, just skip the name. Dena Bank, and these were merged into Bank of Baroda. I guess if you all remember the name, Bank of Baroda. Just give me some time. Vijaya Bank, right? Yes. I just skipped the name. Sorry. Okay, so it was Vijaya Bank and Dena Bank. Dena Bank and Vijaya Bank. So these two banks were merged into Bank of Baroda. Okay? So there was 20 nationalized bank by Indira Gandhi. If we talk about the 20 nationalized bank, right? Now, from this 20 nationalized bank, in 1993, there was New Bank of India. There was New Bank of India, which has been merged into Punjab National Bank. This was the first merger. Second, in 2000, I think 17, this was the merger. Dena Bank and Vijaya Bank, Bank of Baroda, and then this was the merger. So, one, two, three, 4, 5, 6, 7, 8, and 9. So from this 20 nationalized bank, 9 banks were merged till now, right? So if 9 banks were merged till now, so currently we have how many banks left? 11 nationalized bank left, right? Now, if we talk about the private sector bank, first of all, the difference between the public sector and the private sector bank is public sector banks are those banks in which the government undertaking is 51% or more. So if in any bank the government undertaking is 51% or more, then it is a public sector bank. And private banks are those banks in which the government undertaking is 51% less, means less than 51%. If it is 51% or more, then it is a public bank. And if the government undertaking is less than 51%, then it is private bank. So if we talk about the private bank, it was constituted under the Companies Act 1956 and it was operated or regulated under the Banking Regulation Act 1949, operated under the, right? Now, old private banks, there are some old private banks which are set up before the nationalization and there was some new private sector bank which was set up after the nationalization. So the minimum capital requirement for having a private sector bank is currently raised to 500 crores. So presently, if we talk about the minimum capital requirement for a private sector bank, currently it is 500. Clear? Now, scheduled commercial banks. So in this scheduled commercial bank concept, there is a universal bank concept also. So if we talk about the universal bank, first of all, universal bank means those banks which give every possible financial services to their customer. They are not specialized in any one sector. These give every possible financial services to the customer. So in this, there was an initial paid up capital of 500 crore. You have to have a 500 crore capital to set up a universal bank, and you should maintain a minimum net worth of 500 crore at all time, right? Your shares should be listed on any of the recognized stock exchange within the period of 6 years from the time of commencement of your business, right? Now, if we talk about the bank should open at least 25% of their branches in the unbanked rural areas. So if you have satisfied all these conditions, then you are in the category of private sector bank, right? Now, if we talk about the foreign banks are those banks which are established and their headquarters are in the other countries. So these are those banks which have their branches in India. So these are those banks which have their branches in India, but they have their headquarter outside India. So they have their headquarter outside India, but they have their branches set up in India. These are known as foreign banks. Okay. And the last is the regional rural. If we talk about the concept of the regional rural bank, first of all, it was set up with the recommendation of a committee, and the committee's name was Narasimha Committee. So, Narasimha Committee, after the recommendation of Narasimha Committee, regional rural banks had been set up, and it was established in year 1975. Okay, so 2nd October 1975. 2nd October 1975, Regional Rural Bank has been set up under the recommendation of Narasimha Committee, and the name of the first Regional Rural Bank was Pratham Gramin. It was established. Okay. Now, if we talk about the Regional Rural Bank, as per Section 5 of the Regional Rural Bank Amendment Act 2015, authorized share capital of a regional rural bank shall be rupees 2,000 crore. Now, if we talk about the contribution, central government 50%, bank should have 35% contribution in a regional rural bank, and state has 15%. Clear? Done. So these are regional rural bank. Now, what are the objective behind the regional rural bank? First, they bridge the credit gap in the rural areas, right? Second, if we talk about the second, to develop such a measure which could restrict the outflow of a rural person. And third, employment generation in rural areas. So these were the things which were for the establishment of the regional rural bank. Okay, done. Clear? Unit 22 of IEFS Module C, that is banking laws. We are going to discuss about two laws: Reserve Bank of India Act 1934 and Banking Regulation Act 1949. Okay, so this is IEFS Module C, Unit 22. Whoever is watching this video, I just request all of you to just please like and share the video to the maximum you can. And if you haven't subscribed this channel yet, it's a request, guys, that please subscribe this channel and press the bell notification icon. Okay, so let's start discussing this banking law. The very first is the Reserve Bank of India Act. So very important act, Reserve Bank of India. If you talk about the Reserve Bank of India Act, it started in 1926. Okay, 1926, when Hilton Young Commission has recommended the establishment of Reserve Bank of India. Okay, so the Royal Commission on Indian Currency and Finance suggested the establishment of central bank in 1926, and in 1927, a bill to set up the central bank was passed in the Legislative Assembly. Now, after this bill was passed in 1927, the Reserve Bank of India commenced its operation on 1st April 1935. So, Reserve Bank of India Act passed in 1934. In accordance to that act, Reserve Bank of India started their operation and commencement of business on its establishment on 1st April 1935. Okay, and Reserve Bank of India was set up. Very important that you have to remember that Reserve Bank of India was set up as a private bank. Okay, and that time the paid up capital for Reserve Bank of India was rupees 5 crore. Paid up capital for Reserve Bank of India was rupees 5 crore. Right, now, if we talk about the establishment, Reserve Bank of India functioned as a central bank. Means although it was established as a private bank, but it functioned as a central bank, and it at a time served as a central bank for undivided India, means both India and Pakistan and Burma now, which is known as Myanmar. Now, in 1942, RBI ceased to become the central bank of Burma. After the partition of India and independence, RBI operated the central bank of newly formed Pakistan for 1 year till 1948, and RBI ceased to supervise the banking system in Pakistan in 1948. So, 1942, it stopped working for them, and 1948, it stopped working for Pakistan. Okay, but as you all know, Reserve Bank of India was established as a private bank, right? So Reserve Bank of India on 1st January 1949. Reserve Bank of India on 1st January 1949 converted into what? It converted into what? It converted into nationalized bank. Nationalized bank means the government of India took over the control of Reserve Bank of India on 1st January 1949. Clear? Next thing. So, if we talk about the RBI Act, Reserve Bank of India 1934, it is actually divided into five chapters. Very important. So, these are the five chapters in which the Reserve Bank of India is actually distributed. Chapter 1 is actually preliminary. Chapter 2, incorporation, capital management, and business. Chapter 3, central banking functions. Okay, and in chapter third, there is a section A, B, C, D, E, and F, right? Section A is collection and furnishing of credit information. Section B is provision related to non-banking finance company. Section C, prohibition of acceptance of deposit by incorporated bodies. Section 4, regulation of transaction in derivatives, money market, instruments, securities, etc. Section E, joint mechanism, and section F of chapter 3rd is monetary policies. Then chapter 4 is all about general provision and chapter 5 is all about penalty. It's very important these sections, right? So the question can be asked that Reserve Bank of India is divided into how many chapters? So the Reserve Bank of India is actually divided and distributed into 5 chapters. Chapter 1, chapter 2nd, chapter 3rd, chapter 4th, and chapter 5th. Clear? Now, next, if we talk about the chapter 1, preliminary, okay, let's discuss about these chapter one by one. So, chapter 1 has two sections, section 1 and section 2. Now, Section 1, this act actually called the Reserve Bank of India Act, and it is valid for whole India. It is applicable to the complete India, Section 1, and this is the act is called as Reserve Bank of India Act, and the act passed in 1934. Okay. Now, section 2 of this preliminary chapter, it defines a scheduled bank. Now, what is a scheduled bank? A scheduled bank means which are included in the second schedule of RBI Act in 1934. Okay, so scheduled bank means the banks which are included in the second schedule of this. Now, chapter second is regarding with incorporation, capital management and business. Section 3, establishment and incorporation of RBI. Section 4 is capital of Reserve Bank of India. Section 7 and 8 is regarding the management and central. Right now, Central Board of Reserve Bank of India consists of what? Central Board of Reserve Bank of India consists of the governor, not more than four deputy governors. So there is maximum of four deputy governor in the Reserve Bank of India, and these to be appointed by central government, and other directors are nominated by the central government. Right now, Section 9, it is regarding with the local boards and member of the local board. Section 11 is regarding with the removal of office. Section 13 is meeting of the central board. Section 17, business permitted to be conducted by the Bank of India. Section 18A is validity of the loan that not to be questioned. Section 19, the business that Reserve Bank of India cannot transact. Right, so these are the business, these are important. So these are those business in which the Reserve Bank of India is not allowed to do transaction. RBI is not allowed to have transaction in these sections. First, they cannot engage in trade or otherwise have a direct interest in any commercial, industrial, or other undertaking. Purchase the shares of any banking company or any other company, or grant upon loans the security of any such shares. Cannot make loan or advances, cannot draw or accept bill payable, otherwise they don't demand, and they cannot allow interest on deposit or current account. Clear? So these are those business which RBI cannot do transaction, and these are mentioned under section 19. Very important. Section 19, remember. Okay. Now, chapter 3rd. Chapter 3rd is of Reserve Bank of India 1934 is all about the central banking function. Chapter 3rd of Reserve Bank of India is all about what? It is all about the central banking functions, right? Now, central banking functions, so very important. So, some things are very important, some sections are very important. I'm just telling you all the sections plus, but I'm tick marking you the most important sections, right? So, section 20, bankers to the central government, very important. Okay, section 21, bankers to the state government, again important. Section 22 says it has the right to issue currency note except the 1 rupee note, very important. Section 24, denomination, what type of currency notes they can
right? Section 21, legal tender correct character of the currency note. Section 27, reissue of the notes not be done. Section 28, a recovery of lost, stolen, mutilated, or imperfect. Section 28 says that recovery of lost, stolen, mutilated, or imperfect note. Section 29 says that currency note that are exempted from stamp duty. Section 29 says that currency note that are exempted from stamp duty. Section 30 says that power of the central government that it supersedes the Central Board of Reserve Bank of India. So the central government has actually more power and it can supersede the Central Board of Reserve Bank of India if they think that they are not giving their best effort, right? Section 33 is assets of the issue department. Section 34 is liability of the issue department. Section 40 is transaction in the foreign exchange, and Section 42 is scheduled bank keep cash reserve with the Reserve Bank of India. That is cash reserve ratio. Clear? This is very important. So I have picked apart the most important things, right? So section 20, 21, 22, section 30 and section 42, very important, right? Now, now, chapter 4 is general provision. Chapter 4 is all about the general provisions, right? Now, in this general provision, section 48 is exemption of Reserve Bank of India from income tax and super taxes. Section 49 is publication of bank rate. Important. Section 59 is liquidation of Reserve of India. Important, right? Chapter 5 is penalties. So, if there is any wrongdoing, okay, this include that providing any type of wrong information, failure to record the required books and record, and exclusion of any confidential information, it will lead to the penalty, and the penalty can be monetary fines and or it can be a jail of up to 3 years. So this is chapter 5, which is all about the penalties. This is chapter 5, which is all about penalties, right? Now, if we talk about the schedules, so schedules of Reserve Bank of India Act 1934, so RBI Act 1934 has two schedules. They are actually distributed into two schedules, schedule 1 and schedule 2. Okay, whereas if we talk about schedule 1, it details about organization of the country. So according to the schedule 1, complete country of India is actually divided into four areas. Now, what are these four areas? First, there is a western area. Western area, it includes the state of Goa, Gujarat, Madhya Pradesh, Maharashtra, the Union Territory of Dadar and Nagar Haveli, and Daman and Diu. Right? Eastern state consists of Arunachal Pradesh, Assam, Bihar, Manipur, Meghalaya, Mizoram, Nagaland, Orissa, Sikkim, Tripura, West Bengal, and the Union Territory of Andaman and Nicobar. The northern area include the Jammu and Kashmir, Punjab, Haryana, Himachal Pradesh, Rajasthan, Uttar Pradesh, and the Union Territory of Chandigarh and Delhi. And the southern area consists of the Andhra Pradesh, Karnataka, Tamil Nadu, Kerala, and the Union Territory of Pondicherry and Lakshadweep. Clear? So these are the what areas in which the Reserve Bank of India at 1934 is distributed. Okay, western, eastern, northern, and southern area. Now, second schedule means schedule 2 contains all the name of different banks which RBI has approved to have a schedule banks. This is again important. Clear? Banking Regulation Act 1949. So, if we talk about the Reserve Bank of India Act, yes, Reserve Bank of India Act passed in 1934. You have to remember Banking Regulation Act. This was passed in 1949. Okay, so the Indian Company Act 1913, it contained a special provision related to Companies Act. Okay, and then this act, this particular Indian Companies Act, later it was renamed as Banking Regulation Act in 1949. Now, under this Banking Regulation Act, Part 1, please section 1 to 5.
Part 1, it includes what? Section 1 to 5. And in this section 5b, it actually defines the banking condition. Means it actually defines what is banking. So banking is what? Banking is the acceptance of deposit of money for the purpose of lending or investment. So if you are accepting money from the public and it is specifically for the purpose of lending or investment, that is known as banking company. And banking, and 5c define banking company. Okay, now part second, section 6 to 36 AG, this is part second, in which very important is section 6, which actually provides a various list of business which a company may do in addition to the business of banking. So there are different type of business which a banking company do other than the banking business, and what type of business the company is actually permitted. This is defined under section 6 of Banking Regulation Act 1940. Right now, part 4, it is from section 46 to 55, and it actually stress on the main thing, that is restriction on the acceptance of deposit withdrawal by the check. And section 5, it is section 56, which actually have the application of the act to cooperative societies, which is amendment of 1965 and 1920. Okay, IEFS module C, and that is development financial institution. This is Unit 23, Development Financial Institution. We are going to discuss about this unit, right? So let's start discussing this topic, okay? So the very first thing is the evaluation or evolution of the development financial institution. So if we talk about the development financial institution in India, these were established to cater the demand of long-term finance by the industrial sector. So if there is an industrial sector and they have any long-term demand need, these long-term demand needs were actually catered by whom? These long-term finance need is actually catered by the development financial institution, right? So development financial institution, it was established in India in 1948, was the Industrial Finance Corporation of India. The very first DFI was the IFCI. We are going to discuss about this. Okay, so the very first development financial institution, it was set up in 1948, and it was what? The Industrial Finance Corporation of India. If we talk about the good number of financial institution, so a good number of financial institution in 1974, NABARD, it was in 1982, Exim Bank in 1982, SCICI Limited, means Shipping Credit and Investment Company of India Limited, in 1986, PFC Power Finance Corporation, and IRFC Indian Railway Finance Corporation in 1986, and IREDA, that is Indian Renewable Energy Development Agency Limited, in 1987. So these were the development financial institution in India. Okay, the very important thing is the very first development financial institution in India, it was established in 1948. The very first development financial institution of India, it was established in 1948, and it was established with the Industrial Finance Corporation of India, means IFCI. Okay, now if we talk about the objective, means for what objective these development financial institution that has been set up. So if we talk about the main objective behind the development financial institution, first, to serve as an agent of development in various sectors. So it is serving as an agent of the development in different sectors, right? It actually accelerates the growth of economy. It actually speed up the growth of economy. It actually allocate resources to priority areas. Okay, it actually foster rapid industrialization. It actually what? It actually foster the rapid industrialization. Okay, everyone. Everyone who is watching this video, just please like and share the video to the maximum you can. Everyone. Okay, to serve as an agent in the development of various sector, right? So accelerate because it actually provide long-term finance to industry, so it accelerate the growth of economy. It actually allocate the resources to the very high priority sector. It help in the rapid industrialization. Particularly, this rapid industrialization is in the private sector, right? It foster the public-private partnership. It helps in the development of entrepreneurship skill. It promote the development of rural areas. It helps to finance housing, small-scale industries, infrastructure, social utilities. It helps in planning, promoting, and developing industries to fill the gap in industrial sector, right? So these were the objectives of the development financial institution. These were the objective of what? The development financial institution, right? Now, if we talk about the classification of the development financial institution, so how the development financial institution is to be classified, right? So first of all, there is development bank, a specialized bank, investment bank, and state level institution. Okay. So, if we talk about the development banks are IFCI, IDBI, ICICI, SCICI, SIDBI, and NAFID. These are the development banks of India. A specialized type of financial institution is one of the branch of the development financial institution. So, a specialized financial institution like there is Exim Bank, there is NABARD, there is TFCI, there is TDICICI. So this is the specialized financial institution. Investment institution like there is LIC, there is UTI, there is state level institution like there is SFCs, there is SIDS, okay, SIDCS, okay. So these were the classification of the development financial institutions. So there are development bank, there are specialized financial institution, there are investment institution, there is the state level institutions, etc., right? Next, if we talk about the IFCI, Industrial Finance Corporation of India, okay, so the government of India, they actually established the Industrial Finance Corporation of India, and they established this Industrial Finance Corporation of India on July 1, 1948. So they established this on July 1, 1948. Okay, and it is according with the act, which is Industrial Finance Corporation Act 1948. Right. Now, next, if we talk about IFCI, so IFCI, it was the first development financial institution. This is very important, okay, which is actually set up for the economic growth, development of infrastructure and industries, right? Now, there is an authorized share capital of IFCI. So the authorized share capital of IFCI was only 10 crores. The authorized share capital of IFCI, Industrial Finance Corporation of India, was only rupees 10 crore at the initial stage, right? And it was started with an authorized capital of rupees 250. Okay, activities of IFCI, these are actually broadly classified into two categories. These are broadly classified into how many categories? These are broadly classified into two categories. First, there is a financing activity. Financing activities like you should give loans and advances and project finance, right? So you are helping them with money, financing activities. But there are promotional activities also. Now, promotional activities like you are giving the industrial promotion to them, entrepreneur development to them, you are giving infrastructure development to them. So these are the financing and promotional activities. IFCI, Industrial Finance Corporation of India. Clear? Next, if we talk about the next development financial institution, so the next development financial institution is ICICI, Industrial Credit and Investment Corporation of India. ICICI, it is what? Industrial Credit and Investment Corporation of India. Okay, so ICICI, if we talk about the ICICI, it was established in 1950. So it was established by the initiative of whom? It was established by the initiative of World Bank. It was established by the initiative of Government of India, and it was established by the initiative of representative of Indian industry, right? So World Bank, Government of India, and all the representative of Indian industry, right? If we talk about the principal objective behind this development financial institution, the principal objective was to create what? It was to create the medium term, long term project finance to Indian business, right? If we talk about in 1999, this was the year that ICICI became the first Indian company and the first bank to be listed on the New York Stock Exchange, and it was the first bank from non-Japan Asia which was listed on New York Stock Exchange, right? 2002, this ICICI, it was merged with ICICI Bank, and it created the very first universal bank of India. So March 2002, वो ICICI Industrial Credit and Investment Corporation of India, these merged with the ICICI Bank, and they create the very first universal bank of India, right? Now, if we talk about this ICICI, they set up the venture fund Cooperation Limited for the promotion of greenfields project and the risk capital investment. Now, ICICI, if we talk about this promoted the HDFC Housing Development Finance Corporation that helps to provide the long-term finance to individual in middle and lower income group category, right? Now, if we talk about the Credit Rating Information Service of India Limited, CRISIL, very important thing, this was also set up in association with the Unit Trust of India, and it was set up for what? It was set up to provide the credit rating services to the corporate sector. It was actually to provide the credit rated services to the corporate sector. Clear? Done? Now, next thing, if you talk about the Industrial Development Bank of India. Industrial Development Bank of India means IDBI. It was set up to accelerate the industrial development growth in the country. See, IDBI, Industrial Development Bank of India. IDBI, Industrial Development means it was actually for the setting up of industrial bank in India, right? So, Industrial Development Bank of India, it was set up to accelerate the industrial development growth in the country, right? If we talk about the IDBI, it was established in 1964 as a wholly owned subsidiary of Reserve Bank of India. It was set up as the wholly owned subsidiary of Reserve Bank of India. The ownership of IDBI, it was transferred to the central government on 16 February 1976. If we talk about IDBI Act, Industrial Development Bank of India Act, okay, it was amended in the year 1994, and it was to permit the public ownership up to 49%. Means, first of all, the public ownership is allowed and it is up to 49%. Okay, and now in 1995, this was raised it raised more than 2000 crore from its first initial public offering, and thus the government stake was reduced to 72%, and later it was reduced to 58%. So currently, if we talk about the current stake, so IDBI currently have 58% of government stake, okay, and it has the authorized share capital of 5,000. Now, there are some direct assistance and indirect assistance of IDBI, Industrial Development Bank of India. There can be some direct assistance also and indirect assistance also. If we talk about the direct assistance, what are the direct assistance? So there is a project finance assistance. There are different type of soft loan scheme. Soft loan scheme means, you can say, in which there is no necessity of providing the interest, so interest free credit is given, right? So interest free credit is given. So project finance assistance is there. Soft loan scheme means interest-free credit is there given. Technical development fund scheme is given. Rehabilitation of assistance to sick unit. These are given as a direct assistance. Whereas there are indirect assistance. Now, indirect assistance, like there is a refinance assistance for industrial loan. There is rediscounting of bill. There is seed capital assistance. There is promotional activities, right? So there are some direct assistance also, and there are some indirect assistance for the Industrial Development Bank of India also. Clear? Now, if we talk about the SIDB, okay, SIDB means the Small Industries Development Bank of India, SIDB. Okay, so Small Industries Development Bank of India, it was set up in 1990. Okay, now if we talk about the SIDB, presently the government and 22 financial institutions they hold shares in SIDB. Okay, Small Industrial Development Bank of India. And if we talk about the headquarter of SIDB, yes, the headquarter of SIDB is in. Okay, and the very important portion is the largest three shareholders of SIDB is first the government of India. They hold the largest shares in SIDB. Second, the State Bank of India, SBI. And third, the Life Insurance Corporation of India. So SIDB, Small Industrial Development Bank of India, it was set up in 1990. Presently, the government 22 financial institutions they hold shares in SIDB, Small Industrial Development Bank of India. There are the largest three shareholders. The three largest shareholders of SIDB is the Government of India, State Bank of India, and the Life Insurance Corporation of India. Right now, if we talk about the loan scheme, first of all, SIDB Make in India soft loan fund for MSME. Micro, small, and medium enterprise. So, SIDB Make in India soft loan fund for micro, small, and medium enterprises. Okay, the minimum loan size is rupees 10 lakh, and the equipment finance and minimum loan size for other is rupees 25 lakh. If we talk about the loan time period, the tenure of this it is up to 10 years including 3 years moratorium. Moratorium means in this time period you have to give no EMIs for the loans, right? Now there is Smile Equipment Finance, SEF also. See, you have to learn the full form, very important thing. Minimum loan amount size is rupees 10 lakh in this. Okay, now if we talk about the loan tenure, it is up to 72 months. Okay, next if we talk about the loan under partnership, OEM, original equipment manufacturer. Loan under the partnership, it is original equipment manufacturer, right? The loan amount is up to rupees 1 crore and the tenure is up to 5 years. If we talk about the working capital cash credit, okay, so the loan amount it depends upon the financial appraisal, and the loan tenure is as per the terms and condition of the facility. So it says for SIDB, Small Industrial Development Bank of India. Okay, if we talk about Exim Bank. Exim Bank is the Export Import Bank of India. See, these are the special development financial institutions. See, you have to learn the full form, you have to learn the headquarter. This is very necessary for all of you, right? So, if we talk about the Export Import Bank of India. So, Export Import Bank of India, first of all, it was established under the Export Import Bank of India Act 1981, and this act actually, it act passed in 1981, whereas it start functioning in 1982. So act was passed in 1981, but it started working in 1982. Okay, now if we talk about this bank is actually the wholly owned subsidiary, wholly owned by Government of India. So Exim Bank is especially for what? Exim Bank is especially for the promotion, right? If we talk about the Exim Bank, it is especially for the promotion of import and export. It is actually for what? Promotion of import and export, right? So obviously it was set up by the Government of India. Clear? Done? Now next thing. Let's talk about the National Housing Bank. Okay, NHB, National Housing Bank. Very important. Which committee has recommended this National Housing Bank? See, it is very important. Okay, which committee has actually recommended this National Housing Bank? So, if we talk about the committee, Dr. C. Rangarajan Committee, Dr. C. Rangarajan Committee, who was the Deputy Governor, okay, of Reserve Bank of India. This committee has been set up and it actually examined and proposed the recommendation of National Housing Bank as an autonomous housing finance institution, right? Now, if we talk about the National Housing Bank was set up on July 9, 1988, and it was under the National Housing Bank of India Act 1987. Reserve Bank of India, if we talk about the Reserve Bank of India, the entire paid up capital of the Reserve Bank of India with the bank was initially set up. In the year 2019, Reserve Bank of India has divested its share in the bank, and now the bank is the fully owned, or now bank is fully owned by Government of India. It means that at the initial stage, National Housing Bank was set up by Reserve Bank of India, right? But 2019, Reserve Bank of India has divested its shares into the bank, and now it is the bank which is wholly owned by the Government of India. Currently, it is under the control of Government of India. Clear? Next is NABFIT. Now, NABFID, first of all, you have to learn the full form. National Bank for Financing Infrastructure and Development. This is NABFID 2020. Okay, so National Bank for Financing Infrastructure and Development, NABFID, right? If we talk about the NABFID is regulated and supervised as an all India financial institution. AIFI. Okay, so NAFID is what? Regulated and supervised as an all India financial institution, and it was by the Reserve Bank under Section 45L and 45N of Reserve Bank of India Act 1930. Okay, if we talk about the NAFID Act is actually divided into two category. Okay, and the category is not two category. It is divided into 7 chapters, which consist of 48 sections. Right. If we talk about the NAFID is actually meant to establish the National Bank for Financing Infrastructure and Development, which actually help in the long-term non-recourse infrastructure financing in India. Non-recourse infrastructure financing in India means if defaults happen from the borrower side, this bank has to absorb all the losses, right? So, for especially the non-recourse infrastructure financing, National Bank for Financing Infrastructure and Development, this has been established. NAPFID has been established. Clear? Done. So, this was the important development financial institutions that you have to remember. Now, let's talk about some of the practice questions for the class. First, which was the first DFI, development financial institution that has been set up in India? That was set up in India. The very first development financial institution that was set up in India, IDBI, SIDBI, ICICI, or IFCI. Everyone, please answer this question. The very first development financial institution that was set up in India was. Everyone, please answer this question. The very first development financial institution that was set up in India was IDBI, SIDBI, ICICI, or IFCI. Everyone, please answer this question. You can all answer this question. The very first development financial institution. So, I have already told you in the very first page, the very first development financial institution which was set up Everyone, please answer this question and please like and share the video to the maximum you can. So, the very first DFI that has been set up was IFCI, Industrial Finance Corporation of India. So, there was Industrial Development Bank of India, there was SIDBI, Small Industrial Development Bank of India, there was ICICI, there was IFCI. So, the very first development financial institution that has been set up in India was IFCI, Industrial Finance Corporation of India. Okay. Now, with the onset of liberalization, what structure was adopted by DFIs, development financial institutions? So, when liberalization was done, okay, so liberalization was done in various fields. So during the liberalization, when there was the beginning of liberalization, what structure which was adopted by DFIs? Okay, it was the commercial bank, it was the universal bank, it was the mortgage bank, or it was collateralized bank. Everyone, what structure was adopted by development financial institution? Everyone, please answer this question. So, if we talk about with the onset of liberalization, what structure was adopted by development financial institution? Yes, it was the universal, right? Now, the last question is yes, universal bank is the correct answer. Already discussed 23 units in IEFS. Okay, and I was on 1 week off, and now we are starting with Unit 24 of IEIFS, that is Module C, Microfinance Institution. So in today's class, we are going to discuss about the microfinance institution, right? So microfinance institution. If we talk about the microfinance institution, they provide small loans and other financial services to the poor and low income household. Okay, so if you are a poor and if you belongs to low income household, you are poor, you belongs to low income household, right? So microfinance, these are the services which are provided. Microfinance, very simple, they are actually focusing on the poor and low income households, right? So if you have an annual income of rupees 3 lakhs or below. Okay, so if you have on an average the annual income of rupees 3 lakh and below, you are belong to the low income household, and providing financial services, especially to this segment, okay, then it is known as microfinance, and it is a very good economic tool for the financial inclusion. Right? Financial inclusion means what? Connecting maximum people to the financial system of the economy, right? So when you are giving services, because see, to the upper class or to the middle class, the services has been given, right? So automatically, because bank gains a lot of profit from themselves, right? Bank earns a lot of profit from them, from the higher class or middle class. So they are focusing on the banking services to these segments only. But due to these things, the middle class and the lower segment, especially the lower income household, they are neglected and they are not included to the financial system. And to solve this problem, microfinance has been established. So microfinance is what? The microfinance institutions has been set up for providing microfinances, and microfinance means providing the financial services to the poor and low income household, right? Now next, if we talk about the Grameen Bank model, so Grameen Bank model is again one of the microfinance institution model. Okay, Grameen Bank model, these Grameen Bank model has been set up by Professor Muhammad Yunus. Okay, so there was Professor Muhammad Yunus in Bangladesh, Jobra, in the village of Jobra, Bangladesh. He established the first Grameen Bank in 1983. Okay, so this concept has been conceptualized in 1976. After the concept have been conceptualized, it has been established in 1983 in the village of Jobra in Bangladesh, right? And this was Professor Muhammad Yunus, right? So if we talk about the Grameen Bank model, the members of the group are also the owners of the bank. Okay, the group normally consists of 5 members. This group normally consists of what? 5 members, and the liability to repay the loan lies with the individual. The loan is given directly on the basis of trust. The loan is given directly on the basis of trust, and no agreement or documents is required, right? Last, the success of the Grameen Bank proved that the poor needed access to the financial services rather than the cheap subsidized credit. So the focus of this Grameen Model Bank is actually to provide what? Is actually to provide access to the financial services. Okay, they want, or they, there is a thing that the poor or the lower income household, they want to have subsidized, they don't want to have a subsidized credit. They rather want to focus more and more on the financial service. They need to have a financial services, they need to educate themselves more and more on the financial services. There have been different types of, you can say, different types of things that have been provided to them. There have been different services, like in the form of current or saving account. These have been provided to them, so that these lower income household category groups, they just educate themselves about all the financial services. Okay, and this actually wants that we need to be more included toward the financial system of the economy. We just don't want to have, there is, yes, there is a need of subsidized credit, cheap subsidized credit, but this is not only the need. We also want to have an excess of the financial service, and this is more important. This is more important than the subsidized credit, right? So Grameen model is actually based on these concepts. Very important. Who actually formed this Grameen Bank model? So Professor Muhammad Yunus, and in the Jobra village of Bangladesh. Clear? Now, if we talk about the how this microfinance is actually delivered. So you know that what is microfinance? Microfinance is providing the services, financial services to the lower income household category, right? If we talk about the microfinance, so microfinance, delivery of the microfinance, we have self-help groups. Okay, we have what? Self-help groups. Self-help groups are the small informal group of 10 to 20 individuals. So, what is self-help group? These are the informal group, and these include 10 to 20 individual, and these are those which have homogeneous with respect to social and economic background. So, if you have a similar economic background, if you have a similar social background, okay, you are homogeneous in nature, then obviously the self-help group, the informal group, the 10 to 20 individuals are considered under this self-help group. They voluntarily come together, and they help in promoting saving habits among the members. And for a member, for a means platform members, right? For means platform. So for a common process to raise and manage resources for the benefit of the group member. Now, it is actually very preferred that all the members should be below the poverty line. Okay, so all the members should be below the poverty line, BPL. Okay, this can be the exceptional cases, like in normal cases to 20, or in exception cases, maximum to maximum 30% can be above the poverty line, but they should be marginally above the poverty line. Means there should be no rich person in a self-help group. Okay, so if you have a self-help group, the priority is actually given to the members which are below the poverty line. Priorities are given to the members which are below the poverty line, right? But if you bound, or you want to include some members which are above the poverty line, okay, so important thing, this is this, that it should be marginally,
it should be marginally above the poverty line, and max to max 30%. In normal circumstances 20% is allowed, but max to max 30% is allowed for the marginally above the poverty line. Right now, if we talk about the member of the self-help group, they voluntarily come together to save a smaller amount regularly. As you all know how the self-help groups model work. So the member of self-help group, they voluntarily come together, save a smaller amount regularly to a common fund and for meeting their emergency need. Now this common fund is lent to the member who are in the emergency, right? And the self-help group, nowadays some self-help groups also have the bank support with themselves, right? So these self-help groups have the external funding also, like they are receiving fund from the bank also, which helps them to gain the concept of the self-help group in different areas, right? Now next, if we talk about the microfinance institutions, okay, so as per the NABARD, if we talk about the NABARD definition, National Bank for Agriculture and Rural Development, microfinance institutions are defined as those which provide thrift credit and other. It's and a note and other financial service to the product of very small amount, mainly to the poor in rural, okay, or urban, or for enabling them to raise their income level and improve living standards, right? So microfinance institution, these are those institutions which provide microfinance to the individual, right? Now if we talk about the microfinance institution, there are three things in the microfinance institution. We have not for profit microfinance institution, we have mutual benefit microfinance institution, and we have for profit microfinance institution, right? So if we talk about not for profit microfinance institution, these are those societies which are registered under the Societies Registration Act 1860. Okay, so these are registered under what? These are registered under the Societies Registration Act 1860. Mutual benefits microfinance institution, these are individual, or these are those which included under the state and national cooperative mutual aided cooperative societies, which are set up under the Mutually Aided Cooperative Societies Act, which was enacted by the government of Andhra Pradesh in the year 1955. And there is for-profit microfinance institution, which is NBFCs, MFIs, which is the most common type of microfinance institution. These are actually in the form of non-banking financial companies, NBFCs. These are actually in the form of what? Non-banking financial companies. See, so very common. This is actually very common. Microfinance. Okay, this is very common for profit microfinance institution, which is also known as NBFC MFI. This is the most common, and if I'm saying that this is the most important microfinance institution, right? So these are those non-banking financial institutions, especially they are registered under the Companies Act. They are regulated by Reserve Bank of India. Most of the microfinance in India are through microfinance institutions that fall in this category, and they form the largest category of the MFI. Non they are the largest credit or largest category of microfinance institution, right? So microfinance institution, first of all, they provide microfinance services to the individual, right? If we talk about the microfinance institution, there is a not for profit microfinance institution, okay? Not for profit microfinance institution, these are the societies which are registered under the Societies Registration Act 1860. First of all, these are registered under the Societies Registration Act 1860. Mutual benefit microfinance institution, these are under the state and national cooperative and mutually aided cooperative societies, which are set up under the Mutually Aided Cooperative Societies Act, Andhra Pradesh, in the year 1955.
Okay, and there is a for-profit microfinance institution. For-profit microfinance institution are those non-banking financial companies which are registered under the Companies Act. First of all, it is registered under what? It is registered under the Companies Act, right? And it falls under the non-banking financial companies microfinance institution category. Okay, and they form the largest category of the microfinance institution. Okay, now if we talk about the self-help group bank linkage program, very important. For self-help group, these are under the three models. These are working under the three models, right? Model one, model second, and model third. Very important. So self-help group bank linkage program operates under three models. First model is NABARD bank self-help group. First model is what? First model is NABA, bank, and self-help group. So under this model, self-help groups are formed and directly financed by bank. Okay, there is no NGO intervention. There is no NGO intervention. So model one is what? Under model one, NABARD Bank Self-Help Group. Under this model, self-help groups, these are formed directly and financed directly by the bank. Okay, there is no NGO's intervention in between, right? Second model is known as NABARD Bank Self-Help Group. Now, NABARD Bank Self-Help Group, this model has NGO as a facilitating agency. Now, under this model, the NGOs will promote the self-help. Under this, what it is doing, the NGO is actually promoting the self-help group and link them with the bank and link them with the bank. The self-help group formed by NGOs are directly financed by the bank. These are directly financed by the bank. This is the most popular model, and the majority of the self-help group are financed by the bank under the model second. Okay. Third, third is NABARD Bank NGO self-help group as and with the NGO as a financial intermediary. Now, in this, the fund flows from banks to NGOs. The fund flows from banks to what? To NGO, right? If we talk about the self-help groups are financed by the bank through the NGOs. Clear? So these are the three models. These are three models. Okay. So the first model is NABARD Bank Self-Help Group. Under this model, the self-help groups are formed and directly financed by the bank. There is no NGO intervention. Under the second model, NABARD Bank Self-Help Group, and in this, the NGO is acting as a facilitating agency, right? So NGO will actually do what? It promotes the self-help group and link them with a bank. Right now, the self-help group formed by MGO are also directly financed by the bank. This is the most popular model, and the majority of the self-help groups are financed by the bank under model second. Now, third, in this, NGO act as a financial intermediary, means the fund flows from the bank to NGO, and then the NGO gives fund to self-help, right? So this is the model third, right? Clear? Now next. Next is non-banking financial companies, microfinance institution, the most important topic of this chapter. It is the most important topic of this chapter, right? So, if we talk about the NBFCs, okay, non-banking financial company, microfinance institution, first of all, it is a non-deposit taking NBFC, okay, or MFI. Okay, means these NBFCs are not taking deposits, demand deposits from the public, and they are licensed companies, licensed, okay, and they are registered under the Indian Companies Act 1956, and they have to meet the following conditions. And the following conditions are, first of all, the minimum requirement of a microfinance loan is 75% of the total assets. So when there is a microfinance loans, okay, first of all, for having the NBFC MFI, you should lend at least 75% of your total assets as a microfinance loan. Second, Under the earlier guidance, the NBFCs does not qualify as NBFC MFI cannot exceeding 10% of the total asset. It means that if you are a normal NBFC, earlier it was the thing that other than NBFC MFI, if you are a normal NBFC, you are not allowed to lend more than 10% of your total asset in the microfinance loan, because there is a proper NBFC MFI, especially for the microfinance thing, right? But this limit has been revised to 25%. So currently, if you are a normal NBFC and you want to lend in the microfinance loan, you can lend in the microfinance loan, but it shouldn't be more than 25% of your total asset. It shouldn't be more than 25% of your total assets, right? And if you are an NBFC MFI, you should lend at least 75% of your total asset in the microfinance or as a microfinance. Clear? So this is non-banking financial company, microfinance institution. Now, we have discussed some of the important things related to this chapter. Now let's start discussing some practice question, everyone. Okay. The very first question of the class is, okay, the Grameen Bank model was developed in which country? Everyone, please answer this question. The Grameen Bank model was developed in which country? India, Nepal, Sri Lanka, or Bangladesh? The Grameen Bank model was developed in which country? Everyone, please answer this question. The Grameen Bank model was developed in which country? India, Nepal, Sri Lanka, or Bangladesh? Everyone, please answer this question. So if we talk about this question, so the Grameen Bank model was developed in which country? So the Grameen Bank model was developed in Bangladesh. So D is the correct answer. Yes. So remember Professor Muhammad Yunus. Okay. Next. Which of the following types of microfinance institution are regulated by Reserve Bank of India? Which of the following type of microfinance institution are regulated by Reserve Bank of India? Everyone, please answer this question. Which of the following type of microfinance institution are regulated by Reserve Bank of India? So it is NBFC microfinance institution which is regulated by Reserve Bank of India. Okay. Then in which type of financing the self-help group does not act as NGO, act as a financial intermediary? Does NGO act as a financial intermediary? Financial intermediary means the fund flows from bank to NGO and then to what? Self-help group. So what this was the model in NGO as a financial intermediary. So NGO as a financial intermediary, yes, this is a model. Third, NGO as a financial intermediary means this is model. Third, clear? Yeah. Unit 25 of Module C, that is NBFC, non-banking financial companies. We are going to discuss about this chapter. Everyone who is watching this session, it's a request that please like and share the video to the maximum you can. Okay. And if you haven't subscribed this channel yet, guys, it's a request that please subscribe this channel and press the bell notification icon. Okay. So let's start discussing this topic, that is non-banking financial companies, NBFCs. Okay. So first of all, the definition of NBFC. What is the definition of non-banking financial company, right? So according to, if we talk about 1997 amendment in 1997 in Reserve Bank of India Act 1934, a non-banking financial companies means what? A non-banking financial company is any financial institution, first of all, which is a company. Any financial institution which is what? Which is a company. Second, There is a non-banking institution, which is a company and has its principal business of receiving the deposit under any scheme or arrangement in any other manner or lending in any other manner. NBFC, non-banking institution, they are accepting deposit from the public, but these deposits are not a demand deposit. These deposits are not demand deposit, means it is not in the form of current, it is not in the form of saving account, no, right? So non-banking institutions, these accept deposit from the public, but in the other schemes, like if there is any government scheme, you are accepting deposits under any government schemes. Okay, this is not a demand deposit, right? And this acceptance of deposit is for the purpose of lending, right? So non-banking financial companies does all the functions like a normal bank, right? They give you loan, they give you any other facilities, financial services, but the main difference is that a non-banking financial companies is not allowed to accept the demand deposit from the public in the form of current and saving account. They can accept deposit, but in any other government scheme, okay. But the main function of the commercial bank is to accept deposit from the public for the purpose of lending, right? So this demand deposit like current and saving account, this is the forte of what? This is the forte of commercial bank. Such other non-banking institution or claims or such institution as per Reserve Bank of India may, which with the previous approval of central government specifically, right? So these are considered under the non-banking financial company, right? So if we talk about the elaboration, so in terms of section 45 1A, okay, 45 1A of RBI Act passed 1934, a non-banking financial company can commence or carry a business of non-banking institution. Means non-banking financial company can commence the business of non-banking financial institution if they are subjects to these two conditions. First condition, if the non-banking financial company has a certificate of registration, COR, from the bank, that is Reserve Bank of India. So if they have a certificate of registration from Reserve Bank of India, second, they are owning or they are having a net owned fund of rupees 2 crore. So they are having a net owned fund of rupees 2 crore, plus they have a certificate of registration from the bank, that is Reserve Bank of India, then obviously a non-banking financial company can be converted into a non-banking financial institution. This is very important. Next, if we talk about the difference between a bank and non-banking financial company, I have already told you the difference between a bank and a non-banking financial company. So, a non-banking kind financial companies lends and make investments and engage themselves in all type of activities which are similar to banks. Okay, means similar to bank. But there are few differences. There are few differences which are given below. First of all, the non-banking financial company cannot accept demand deposit, like they cannot accept saving or current account. These are not acceptable on the part of non-banking financial companies. Okay, non-banking financial company do not form a part of payment and settlement system and cannot issue checks drawn on itself. Okay, they do not have a deposit insurance facility of Deposit Insurance and Credit Guarantee Corporation. Okay, unlike in the case of the bank. So these are the three things which are different from a normal bank. So NBFCs are allowed to accept deposit from the public, but these deposits are from, you can say, these deposits are on other schemes. These deposits are actually on other schemes. Okay, you cannot accept the demand deposit in the form of current or saving account. You cannot do that, right? So non-banking financial companies is different from these companies in such way, right? So simple, very simple, clear, all of you, non-banking financial companies, right? Now let's talk about the key points of non-banking financial companies. So if we are going to discuss about what are the key points of non-banking financial companies, first of all, The non-banking financial company in India, they are registered under the Companies Act 1956 and 2013. Earlier act was passed in 2000 1956 and the new was passed in 2013, right? And they operate under the regulatory bonds of Reserve Bank of India as per RBI Act 1934. So they are actually as per the Reserve Bank of India Act 1934. Okay, services offered, if we talk about the service offered, they include loans, they include credit, savings, investments, retirement in planning, money market, underwriting, and merger activities. These are all the services which are given by non-banking financial companies, which are same as us. They cannot accept demand deposit. The very important thing is they cannot accept the demand deposit from the public. So non-banking financial companies are not allowed to accept deposits that are withdrawable on demand, right? They do not form a part of payment and settlement system. So if we talk about this, they are not part of the payment and settlement system. Deposit insurance facility. So whatever the deposits the NBFCs is taking from the public in the form of any other government schemes, they are not providing deposit insurance to the customer, which is available generally available to the deposits on the bank. Clear, right? So these are the key point for non-banking financial companies. So non-banking financial companies in India, services offered cannot accept demand deposit. They are not form a part of the payment and settlement system. Clear? Now, if you have any doubt till now, please feel free to ask your doubt, everyone. Feel free to ask your doubt, everyone, guys. Clear? Any doubt? If you have any doubt, kindly ask your doubt. If you don't have any doubt, just please give me a thumbs up, everyone, guys. Done? Okay. Next. Now, evolution of NBFCs. Okay. Now, if we talk about the evolution of NBFCs, non-banking financial companies, very important, the evolution of NBFCs. So the non-banking financial company, they initially operated on a very limited scale. They actually started with a very limited space. They initially operated in a very limited space without making any such impact on the financial industry. In the initial stage, they were not very successful. But in the first stages of development in the Companies Act, they were actually regulating the NBFCs. So at initial stages, all the NBFCs were regulated by the Companies Act. Okay. Now, between 1980s to 1990s, now this was the 10-year time period when NBFCs start gaining some popularity because of their customer-friendly reputation, and they actually attract a lot of investors towards themselves. Right. In 1992, there was a committee, very important. There was a committee which was headed by Mr. A.C. Shah. Okay, A.C. Shah was the former chairman of Bank of Baroda, and they suggest measures for the effective regulation of the industry. Now, in 2016, the government does what? In 2016, the government gave the go ahead for FDIs, foreign direct investment, and that too from the automatic route. Automatic route means you don't need RBI's approval in this case for the regulated NBFCs, those NBFCs which are actually regulated, non-banking financial companies which are actually regulated. FDIs, foreign direct investments, are allowed for the NBFCs, okay, through the automatic route. Okay. So in the initial stages, they were not so popular. Companies Act actually governed all the NBFCs in the initial stage. Okay, but between 1980s to 1990s, this 10-year time period, NBFCs gains customer-friendly reputation and attracts a lot of investor. Right, in 1992, if we talk about 1992, RBI has constituted a committee, and this committee was headed by AC Shah. This committee was headed by whom? AC Shah, right? And this committee, AC Shah was the former chairman of Bank of Baroda, and they actually suggest some effective measure for the regulation of this industry. In 2016, FDIs are allowed, very important, and it was allowed through automatic routes, and FDIs can be taken in the regulated non-banking financial, right? Next, if we talk about the non-banking financial companies, the regulator of non-banking financial companies. See, so to eliminate, in order to obviate the dual regulations, in order to eliminate the dual regulation of certain NBFCs which are mentioned. So there are certain NBFCs, non-banking financial companies, which are exempted from regulation by the Reserve Bank of India, right? So uh, various other than these means which are mentioned, all the NBFCs are regulated by RBI. But for obviously to eliminate the dual regulation, these are those NBFCs which are not under the control of Reserve Bank of India. Now, what are these NBFCs? If we talk about the first, venture capital funds, merchant banking companies, stock broking companies, these are actually registered with SEBI. So these need not to be registered with Reserve Bank of India. So there is a venture capital fund, there is a merchant banking company, stock broking companies. These all registered with SEBI, Securities and Exchange Board of India, right? Now, next, if we talk about the insurance company, they are actually under the control of Insurance Regulatory Development Authority of India. They are not under the control of, or they are not regulated by Reserve Bank of India. Nidhi company, they are notified under Section 620A of the Companies Act, right? And these are regulated by the Ministry of Corporate Affairs. So again, Nidhi companies are out of the scope of Reserve Bank of India. There are chit companies which are defined under Section 2B of Chit Fund Act 1982, and these are regulated by respective state governments. So, whatever the state governments are, and in which there are chit companies, so they are under that chit companies, right? Housing finance companies, these are regulated by National Housing Act, and last are the stock exchange or the mutual benefit companies. They are regulated by CP, Securities and Exchange Board of India. So these are those companies which are not under the regulation of these are not under the regulation of Reserve Bank of India. So in order to eliminate the regulation from Reserve Bank of India, in order to eliminate the registration from Reserve Bank of India, these are the companies which are under SEBI, right? So venture capital, these are registered with the SEBI. There are insurance companies which are Insurance Regulatory and Development Authority of India. There are Nidhi companies which are Ministry of Corporate Affairs. There are chit companies which are by the respective state government. There are housing finance companies which are regulated by National Housing Bank. There are stock exchange or mutual benefit companies which are regulated by SEBI, Securities and Exchange Board of India. Clear? Now, next, if we talk about the classification of non-banking financial companies, so classification of non-banking financial companies, non-banking financial companies are divided into three days. Liability-based classification is there, activity-based classification is there, and size-based classification is there. Now we are going to discuss about these things in the coming slide. So classification of non-banking financial company, it is based on liabilities. The NBFCs are classified on the basis of liabilities. The NBFCs are classified on the basis of activities, and NBFCs are classified on the basis of size, right? Now, if we talk about the classification, the first is the liability-based classification. So, depending upon the liability base, the NBFCs are divided into two categories. So, liability-based means NBFC category A, which is NBFC D. Category A means those NBFCs which are allowed to accept public deposits. Those NBFCs which are actually allowed to accept the public deposit, these are category A non-banking financial companies. And there are category B non-banking financial companies. These are those NBFCs which are not allowed to accept the public deposits. So these are NBFCs D, non-banking financial companies, non-deposit taking. So the maximum period for which the NBFC D can accept deposit from the public is 60 months. Very important, right? So remember, on the basis of liability, there is NBFC deposit taking and there is NBFC non-deposit taking, category A and category B. So NBFC D, non-banking financial company, which are deposit taking, they are accepting deposits for a period of maximum 60 months, right? Now, size-based classification. So on the basis of size, if we talk about the size-based classification, at present, non-deposit taking NBFCs, it have a assets, if they have assets of rupees 500 crores and above, they are termed as systematically important non-deposit taking NBFCs. They are considered as systematically important non-deposit taking non-financial companies. Okay, NBFC, NDSI, systematically important non-deposit taking NBFCs. Okay, next, if we talk about the activity-based classification, so these are the companies or the NBFCs are divided into these categories based on the activities. Now, what are these? There is an asset finance company AFC, there is a loan company LC, investment companies IC, infrastructure finance company IFC, systematically important core investment companies CIC, NDSI, infrastructure debt fund companies IDF, NBFC. There is NBFC Microfinance Institution, NBFC MFI. There is a residuary NBFCs RNBFC. There is NBFCs Factor. There is NBFCs non-operating financial holding companies NOFHC. There is mortgage guarantee company MGC, right? So the details of these companies, it will be covered in the paid session. So if you want to learn the each and every detail of this activity based classification of NBFCs, we will discuss it completely in the paid chapters, right? So I have just covered the most important thing related to the chapter. Okay, now let's start discussing some of the practice questions. First of all, loan company is an NBFC as per which type of classification? Liability, activity, size based, or none of the above? Very easy, you can all answer this question. A loan company. So if there is a loan company is a non-banking financial company and it is based on which type of classification? Everyone please answer this question. It is based on which type of classification? A loan company is a NBFC, non-banking financial company, and it is as per which type of classification? Everyone, please answer this question. It is as per which base of classification? So, if we talk about this is as per which base of classification, it is actually activity base. Clear? Right? Next, what is the maximum period in which an NBFC deposit taking NBFCs, okay, can accept deposit? It is 12 months, 36 months, 60 months, or 120 months. You can all answer this question. Very easy. What is the maximum time period for which a non-banking financial company which is deposit taking can accept the deposit? NBFC-D, it is a liability based classification. First of all, which based classification? Liability based. Under liability based, this is defined as category A, category A, liability based NBFC D, right? What is the maximum period for which NBFC D can accept deposit? 12 months, 36 months, 60 months, or 120 months? So the correct answer is what? So if we talk about the correct answer, yes, it is 60 month, which is the correct answer. 60 month, which is the correct answer. Clear? About Unit 26, Insurance Companies. This is IEFS Module C. So let's start discussing this topic. First of all, the basic introduction. So introduction, if we talk about the insurance, insurance can be defined as a contract. Insurance can be defined as a contract between two parties where one is the insurer and the other one is the insured, right? So here one means the insurer promises the other to indemnify or make good any of the financial loss suffered by the latter that is insured, and which is in consideration for the amount received by the way of premium. So, for example, there is one insurance company and there is one person. What is the contract of insurance? In contract of insurance says that there is insurer, right? This insurer promises the insured person. This is insured and this is the insurer, right? So they promises, this insurance company promised the insured person that if that later means this insured person suffered any loss from any third party, this loss can be covered or indemnified by this insurer. This is known as the contract of insurance. So there is one the insurer, there is one the insured person. And the contract between insurer and the insured is called as the insurance policy. The contract between the insurer and the insured is called as the insurance policy. Clear? If we talk about the insurance are actually the Insurance Regulatory and Development Authority of India. The insurance is highly regulated business. No one means very few sellers are there, and that's why it is considered as a oligopoly market. So it is actually a very highly regulated market, and it is regulated by the Insurance Regulatory and Development Authority of India. If we talk about the minimum capital, so minimum capital that is required to establish a life insurance company is 100 crore. This is very important. So what is the minimum capital which is required to establish a life insurance company? So the minimum capital which is required to establish a life insurance company is 100 crore. So insurance company is a highly regulated entity, and if we talk about the insurance company, the insurance is regulated by Insurance Regulatory and Development Authority of India. If we talk about the insurance policy, right, insurance policy is actually the contract between the insurer and the insured person. Clear? If we talk about the privatization and allowance of private sector in the insurance business, right? So if we talk about the privatization, or when the government allows the private sector into the insurance company. So if we talk about the very first insurance industry which has been open to the private players and foreign direct investment, it was in the year 2000. So before in the year 2000, the insurance was completely regulated by the government. So no private sector was allowed in the insurance business. But later, government want to what to the government want to dilute their shares. Okay, so they started privatization. So you all know that 1991 was a big year in which the economic policies reforms has been changed, and in which the government has allowed a different private sector to, and they give entry to different private sector in different government dominated area. And so as the insurance, so first the insurance was open to the private sector, and the foreign direct investment, it was in the year 2000, right? And it was when the government permitted the foreign direct investment to the extent of 26%, right? At the very initial stage, at the very first stage, when the FDIs and the private sectors were allowed, 26% was given to the insurance company. 26% was given to the insurance company, right? Now, this cap was increased to 49% in 2015. So, in 2000, only 26% was allowed. But if we talk about in 2015, this cap was increased to 49%. So, now 49% is allowed, right? And if we talk about the current, so currently 21-22 budget, the foreign direct investment in insurance sector has been increased to 74%. But if you are a regulated entity, you are insurance intermediary and you are regulated by Insurance Regulatory and Development Authority of India. So for you, 100% FDIs are allowed. So there are two things. In the insurance sector, as an insurance companies, the FDIs which is allowed is 74%, right? But if you are an insurance intermediary, if you are a insurance intermediary, then for you the percentage which is allowed is 100%. So these are two things. Do not get confused in these things, right? Now, next, if we talk about the next thing, insurance penetration and density. Insurance penetration and density, very important topic. See, insurance penetration and insurance density, these are very important to understand. Okay, you have to very clear of the numericals, as well as you have to be very clear in the formula as well. Formula is also very important, and numerical is also very important for all of you, right? So, first of all, insurance penetration and density. What are the essence of this insurance penetration and density? So, insurance penetration and density actually reflects the level of development of insurance sector in a country. So, what is the level of the development of insurance sector in a country? Okay, how the insurance sector, how the people are aware of the insurance sector, how they are take or they are utilizing the opportunity to take care of the insurance sector in India, how they involve insurance in their normal business or day-to-day life, right? So what is the percentage of acceptance of insurance in the country? This is reflected by penetration and density. When we talk about the penetration, penetration is the percentage of insurance premium to GDP. So what is insurance penetration? So if we talk about the insurance penetration, so the formula of insurance penetration is what? It is insurance premium, the insurance premium divided by what? It is divided by gross domestic product, means GDP. Very important formula. Whereas if we talk about the insurance density, again it is very important. What is the formula for insurance density? Insurance density is actually the ratio of premium to population. Means it is the insurance premium. It is what? It is the insurance premium to what? It is insurance premium to population. So by, if we talk about the density, density is per capita insurance acceptance in the country, right? So per capita premium. So on an average, a person is giving how much premium to the insurance sector. This is actually measured by insurance density. Whereas insurance penetration actually measures the acceptance of insurance in the country. And it is actually the ratio of premium to GDP, and it is actually the ratio of premium to population. The two formulas are very important. This slide is very important because you can get numerical question from here. So you have to be very aware of all the numerical question, because you can get the numerical question from here, right? If we talk about the number of insurance companies which are operating in India, so as the end of March 2020, so this data is as per March 2020, end of March 2020, there were 68 insurers operating in India. So a total of how many insurers that were operating in India? So there was total of 68 insurer that was operating in India. Okay, out of 68, 24 were life insurers, right? 27 were general insurers, 6 were stand-alone health insurers, and 11 are reinsurers. So 24 life, 27 general, 6 stand-alone, and 11 are were reinsurers, right? And it includes everything. It includes the branch of foreign reinsurance also, and Lloyd's India also, right? Now, if we call the 68 insurers, so out of which how many are public and how many are private? Okay, so out of the 68 insurer in operation, 8 were in the public sector. Out of 68, 8 in what? 8 in the public sector. Only 8 in the public sector, and 60 insurers were in the private sector. And out of private sector, if we talk about the classification, so there are 23 life insurer in the private sector, 21 is general insurer in the private sector, 6 is standalone health insurer in the private sector, and 10 are reinsurer in the private sector. And there is Lloyd India's. Okay. Now, I have given you a chart here, so you can just learn the data by this simple chart, right? So the chart says that, first of all, there's a type of insurer. This actually says the type of insurer. There is a public sector. How many public sector insurers are there? How many are private sector insurers are there? And how many totals are there, right? So if we talk about the life insurer, there is one public sector, there is 23 private sector, and there are 24 total life insurer, right? General, if we talk about the general, 6 are private, 6 are actually public, 21 are private, and 27 are total. Okay, just wait a minute, guys. Okay. So we were talking about the total number of insurer, right? So if we talk about the total number of insurer, okay, so currently the life insurance, it is 1 in public sector, 23 in private sector, and total there are 24, right? If we talk about the general, okay, so in general, 6 are from the public sector, okay, then we are saying 21 in the private sector, and total there are 27, right? Then standalone health. So in health, there is no public sector. Okay, no players in the public sector. In the private sector, there are 6 players, and total we have 6 players. Reinsurer, in the public sector, there is only one. In the private sector, there are 10 reinsurer and 11 in total. So total number, public sector has 8, private 60, and total are 68. It is as per 2020 data. Clear? Okay. Next, if we talk about the next thing, so what are the legislation for governing the insurance company? So there are different act, there are different legislatures for governing the insurance companies, right? So if we talk about the Insurance Act, okay, so there is the Insurance Act 1938, there is Insurance Regulatory and Development Authority Act 1990. Okay, Insurance Act 1938, there is Insurance Regulatory Development Authority Act 1999. Okay, there is a Life Insurance Corporation Act 1956. There is General Insurance Business Nationalization Act, that is 1970. So these are what? These are the legislation, so which are governing the operation of insurance companies in India. Okay. Next, if we talk about the insurance intermediary. Now, what are the insurance intermediary? So, insurance intermediary means they act as a bridge for connecting the consumer with the insurance company. So, insurance intermediaries serve as a bridge, and these are the bridge between the consumers and the insurance companies, right? If we talk about the insurance brokers, these are licensed by IRDA and it was governed by the Insurance Regulatory and Development Authority Regulations 2000. If we talk about an agent, who was an agent? Agent is a person which is licensed by the authority and it is actually to carry out the business, insurance business, and it include the business related to continuance, renewal, revival of policies of insurance, etc. An agent can be an individual agent and an agent can be a corporate agent. So this is the insurance intermediary. So insurance intermediary is what? Insurance intermediary act as a bridge. It is what? It is acting as a bridge. And bridge between what? Bridge between consumer and insurance company is act as a bridge between consumer and insurance company. If we talk about the insurance broker, they are licensed by Insurance Regulatory and Development Authority, right? And if we talk about the agent, agent is a person who is licensed by the authority to solicit and procure insurance business. And this includes a business which is related to the continuance also, renewal, revival of the policies and insurance also. Clear? Done? Okay, now next, if we talk about the reinsurance. Now, what is a reinsurance? If you all heard about the reinsurance thing, reinsurance means insurance of the insurance company. Reinsurance is what? Insurance of the insurance company. Reinsurance is actually a process when insurance company transfers some or all of the risk to another insurance company, right? This will help the seeding company to manage their risk exposure and helping them maintain the financial stability. Essentially, this is very important because reinsurance act as an insurance for the insurance company. They transfer their some of the risk to what? To another insurance company if they think it is necessary, right? So reinsurance involves what? Transferring some portion of the risk, okay, to the reinsurer, and thus enable the insurance company focus on their core business. It is termed as, you can term is reinsurance as the insurance of the insurance company. You can term it as insurance of the insurance company. Clear? Done? Now next. Last is e-insurance. E-insurance means electronic insurance account. Now, what is e-insurance? E-insurance is actually the insurance that you maintain all your insurance policy document. When you maintain all your insurance policy document in the electronic format, when you maintain them in the electronic format, then it is known as what? Then it is known as e-insurance. E-insurance account help you to facilitate the policy holder by providing access to the insurance portfolio at one click, because it is present, the complete document present in the what? In the online format. So you don't have to go and search and then every time you have to carry a bundle of agreement with yourself. No, all the things are stored in the electronic account. Then it is known as what? E-insurance account, right? So insurance is a very small topic. We have discussed the complete chapter here. Now let's talk about some of the practice questions which are related to this insurance company or the insurance thing. So the very first question is, the very first insurance company which is established in India is what? The very first insurance company, everyone. The very first insurance company, everyone. The very first insurance company to be established in India. You can all answer this question. So the very first insurance company which was established in India was Oriental Life Insurance Company. The very first insurance company which was established was Insurance Oriental Life Insurance Company, right? What is the extent up to which foreign direct investment is presently permitted in the insurance sector? It is an important question. Plus, this is actually the previous exam cycle question, right? So previous year question, it is one of the previous year question. What is the extent of foreign direct investment which is permitted in the insurance sector? What is the extent of the FDIs which is permitted in the insurance sector? Everyone, please answer this question. Everyone, please answer this question. So the correct answer is, so if we talk about the correct answer, what is the extent of the what FDIs which are permitted in the insurance sector? So extent of the foreign direct investment which are permitted in the insurance sector is 74%. So C is the correct answer. 74% is the correct answer. Okay. Done? Okay. And last is, what is the percent, not last, the percentage of insurance premium received to GDP. Premium to GDP is called as premium to GDP. Everyone, premium to GDP. You can all answer this question. Premium to GDP. So premium to GDP is what? I have told you, very important, the insurance premium to GDP is penetration. And when we talk about insurance premium to population is density. Okay, so questions are very important, right? So first, life insurance company important, extent of FDIs which are permitted in the insurance sector important. Okay, insurance premium to GDP, it is known as penetration, and insurance premium to population, it is known as density. Clear? Unit 27 of IEFS module C, that is Indian financial system, regulators and their role. So we are going to discuss about the important Indian financial systems, the regulators and their role. Okay, so this is unit 27. Everyone who is watching this video, it's a request that please just like and share the video to the maximum you can. And if you haven't subscribed this channel yet, it's a request, guys, that please subscribe this channel and press the bell notification icon. So let's start discussing with this topic, that is Indian financial system, regulators and their roles. So first of all, the most important Indian financial system you all know is Reserve Bank of India. Reserve Bank of India is a central bank. Reserve Bank of India is a regulator of the complete banking system, right? So let's talk about the first and the very important regulator, that is Reserve Bank of India. Reserve Bank of India, you know that during 1920s, if we talk about the 1920s time period, there was failure of approximately 588 banks in the economy. There was actually the failure of 588 banks in the economy, right? And due to this failure, okay, there was a need that there should be a regulator. There should be a regulator who that do what, there should be a regulator who just what, who just take care of the banking system completely, so that there should be no failure of such 588 banks in the economy. That's why, talk about the 1920s time period. During the 1920s, after this 1920, the failure of the bank, there was Dr. B.R. Ambedkar, and there was in 1926 Royal Hilton Young Commission was formed. And in 1926, when Royal Hilton Young Commission was formed, which is also known as Hilton Young Commission, it actually recommended the establishment of Reserve Bank of India. Is actually recommended the establishment of Reserve Bank of India on 1st April 1935. Right? So 1926 Royal Hilton Young Commission recommended the establishment of Reserve Bank of India. Then 1934 Reserve Bank of India Act has been passed, and 1935, 1st April 1935, Reserve Bank of India has been established. Clear? If we talk about when Reserve Bank of India was set up, Reserve Bank of India was working as a central bank for both India and Burma. They were working as a central bank for both India and Burma, which is now also known as Myanmar. And it served as a central bank for Burma for some time period, as well as it served as a central bank for Pakistan also for 1 year. right? Next, if we talk about the Reserve Bank of India, at the initial stage, if we talk about the establishment, Reserve Bank of India, central office of Reserve Bank of India was initially established in Kolkata. The central office for Reserve Bank of India was initially established in Kolkata, but 1937, it was permanently moved to Mumbai. So now the headquarters of Reserve Bank of India is in Mumbai. Initially, the headquarters of Reserve Bank of India was in Kolkata, right? If we talk about the Reserve Bank of India, Reserve Bank of India was set up in 1935. It was set up as a private bank. Okay, it was set up as what? It was set up by as a private bank, but it has some extended functions also. It was served as a private bank in 1935, right? But if we talk about the 1949, the government of India took over the control of Reserve Bank of India, right? And so Reserve Bank of India was nationalized on 1st January 1949. If we talk about the structure of Reserve Bank of India, so there is a governor, there is four deputy governor, there is one governor, there are four deputy governor of Reserve Bank of India, which are appointed by the union government, or you can say which are appointed by the central government, right? If we talk about the Reserve Bank of India, the control of Reserve Bank of India were in a hand of whom? The control of Reserve Bank of India were in the hand of a governor. There are four deputy governor for Reserve Bank of India, 10 directors which are non-official and they are nominated by the union government from various fields. There are two government officials and four others, one each from the local board. So this is actually the structure of Reserve Bank of India. So if we talk about the structure of Reserve Bank of India, yes, control of Reserve Bank of India, first of all, the main thing is the board of directors of Reserve Bank of India. So board of director, it consists of the governor. Okay, so first of all, it consists of the governor. Then it has four deputy governor. It has governor, it has four deputy governor, 10 directors, and these directors are non-official, which are nominated by the central government, and these are from different field. This is not necessary that they should belong to only economics field or technology field. No, they are from different various field. There are two government officials and four others which are from each local boards, right? Now, if we talk about the central board of directors, so the central board of directors, organizational structure of Reserve Bank of India, you can see the organizational structure of Reserve Bank of India. So there is one governor. First of all, if we talk about the organizational structure of Reserve Bank of India, so organizational structure is one is the governor. First is the governor. Then comes the deputy governor. And there are four deputy governor. If we talk about the deputy governor, so there are actually four deputy governor, right? Executive director, there is a principal chief general manager, there is a chief general manager, there is a general manager, there is deputy general manager, there is assistant general manager, there are managers, there are assistant manager and supporting staff. So this is actually the hierarchy of working of the Reserve Bank of India. This is actually what? This is actually the hierarchy of working of Reserve Bank of India. Clear? So if we talk about the Reserve Bank of India, the Reserve Bank of India has different role and functions. Again, this is very important. The role and functions of the Reserve Bank of India, very important. Okay, first of all, it is the monetary authority of the country. First of all, it is what? First of all, it is the monetary authority of the country, right? So monetary authority, so it helps in the regulation of monetary policies. When we are talking about the Reserve Bank of India, it help in the regulation of what? It help in the regulation of the monetary policies. It help in the issue of the currency, or it is actually the issuer of the currency. It is banker and debt manager to the government. It is bankers to the bank. It is regulator of the banking system. It is manager of the foreign exchange. It actually maintain the financial stability, right? It help in the regulator and supervising the payment and settlement system of the economy, in help in different development roles. So these are the different function of the uh, Reserve Bank of India. They are banker to the banks also because they provide a debt and loan facilities to the bank, whereas they are bankers and debt manager to the government also because they provide the same services to different government also, right? And the Reserve Bank of India, a very important thing, this is also known as Reserve Bank of India, also known as lender of the last resort. Reserve Bank of India also known as what? Reserve Bank of India also known as the lender of the last resort. Clear? If we talk about the monetary authority, now you already know about the monetary authority. I have explained you monetary policies, right, in the previous chapters, but let's talk about the monetary authority. So, monetary policy, first of all, what is monetary policy? The word, what is the use of this monetary policy? Monetary policies are those policies which are made by Reserve Bank of India, and it actually helps to regulate liquidity of the economy. It actually helps to regulate what? Liquidity of the economy. Liquidity is also known as what? Liquidity is also known as money supply, right? So, in order to manage liquidity, in order to manage money supply of the economy, right, there are the monetary policies, right? So monetary policies, these are the instrument which are under the control of central bank, and this actually helps to maintain the money supply or liquidity or credit in the economy, right? If we talk about the monetary policies, actually the monetary policies are made by monetary policy committee, which have 6 members in the ratio 3 is to 3. 3 members are from Reserve Bank of India and 3 members are from government, right? Reserve Bank of India, the 3 members from the Reserve Bank of India consist of the governor, main governor of Reserve Bank of India, then there's a deputy governor in charge, and then one officer of RBI, which is nominated by the board of RBI, right? And there are 3 members which are appointed by the central government, and these 3 members are appointed for a period of 4 years, and reappointment. Reappointment of these members are actually not allowed, right? If we talk about the monetary authority, monetary policy meets at least 6 times in a year, right, to determine the policy interest rate to achieve inflation targets set by government, right? So these are the monetary authority. If we talk about some of the instrument of the monetary policy, some of the instrument, there are direct instruments also. There are indirect instrument also, direct instrument and indirect instrument. So if we talk about the direct instrument, there are cash reserve ratio and statutory liquidity ratio. I have already explained it in detail for all of you what are the direct instrument and what are indirect instrument, but I'm just giving you a shorter or a quick revision of these monetary policies, right? So cash reserve ratio means every bank has this compulsory condition that they have to deposit. They have to deposit percentage of its total deposit to RBI. That too in the form of cash. They has to deposit a fixed percentage of their total deposit to Reserve Bank of India, and that too in the form of cash only. That is known as the cash reserve ratio. Statutory liquidity ratio means every bank has this compulsory condition that they have to deposit 6 percentage of its total deposit with itself, and this can be in any form, either in cash or in not cash, either in cash or in not cash. That is known as a statutory liquidity ratio. Clear? Now, what are the indirect instrument? Indirect instrument means there is a liquidity adjustment facility. Liquidity adjustment facility include repos and reverse repo. Now, repo rate and reverse repo rate. Repo rate means is this the rate in which RBI is giving a loan, short-term loan. That loan is what? That loan is a short-term loan. RBI is giving short-term loan to other commercial banks. Then it is known as repo rate. Now, what is reverse repo rate? Reverse repo rate means RBI. actually, or commercial bank actually parking their surplus fund to Reserve Bank of India on a short term basis, control liquidity of the economy, and that is obviously for a short period of time, then it is known as a reverse repo rate, right? I've already explained it in detail in the previous chapters, right? When Reserve Bank of India, we are discussing about the Reserve Bank of India in detail. I have already discussed these repos and reverse repos and technicalities related to repos and reverse repo in very detail. So you can just look out that chapter for a complete detail on this direct and indirect instruments, right? So there is an open market operation, OMO. Open market operation means buying and selling of government securities when Reserve Bank of India buy or sell government securities wholly and completely from the open market, then it is known as open market operation. Either Reserve Bank of India is completely buying government securities from commercial banks or companies or industries or government, or Reserve Bank of India completely selling the government securities to the open market. Open market means the participant can be anyone who have the government securities, right? So this is known as open market operation. Then there is a marginal standing facility, which is then when RBI is giving loan for a period of 24 hours, or you can say for a period of overnight basis. When Reserve Bank of India giving loan to commercial bank for managing their balance sheet, or for just covering the mismatches in the cash balance, and this is actually overnight, right? So this is known as marginal standing facility. There is a long-term repo operations. There is a targeted long-term repo operation. So there are different direct and indirect taxes, or sorry, direct and indirect instrument under the monetary policy. So monetary policies, the direct and the indirect instrument related to the monetary policies, okay, plus what are the features of the monetary policies, these are very important for all of you. Again, I am telling you why it is very important, because you will be getting one or two questions from here, because this is very repetitive. This you will see in PPP also, this you will see in IEFS also. So because this is very repetitive in nature, this is going to repeat very oftenly, and that's why you will be getting questions. You will expect some questions from these monetary policies and from the topic monetary policy, and that's why just keep on revising these monetary policies, and always remember, before going in the examination, just check out the recent rates, okay? What were the recent rates of the monetary policies which is going on, right? Now, next thing, if you talk about the next regulator, let's talk about the SEBI, Securities and Exchange Board of India. So, Securities and Exchange Board of India, first of all, it is known as watchdog of capital market. So there is a capital market, there is a money market. Okay. For managing capital market, of the regulation of the capital market is actually managed by SEBI, Securities and Exchange Board of India. For managing money market, there is Reserve Bank of India. So capital market is managed by SEBI, money market is actually maintained by, or money market is actually managed by Reserve Bank of India. When we talk about the SEBI, Securities and Exchange Board of India, it was established in 1988, but it got legal status or statutory power when SEBI Act 1992 has been passed. So it was established initially in 1988, but it got legal status when SEBI Act 1992 was passed. Okay, when we talk about the SEBI, SEBI is headed by a chairman, okay, which is supported by three full-time members and four part-time members. These are supported by three full-time members and four part-time members. If we talk about the part-time members, who are the part-time members? So this is the government. These are actually officials which are appointed by the government and Reserve Bank of India, right? So this is SEBI. If we talk about the functions of SEBI, so these are the functions of Securities and Exchange Board of India. SEBI has its, if we talk about the SEBI function, First of all, it protects the investors' interest. It protects the security market. It helps in developing the capital market. It regulates the mutual funds. It regulator of the mutual fund, very important. Who regulate the mutual fund? SEBI regulate the mutual fund. So you have to remember this. Insider trading regulation means whenever there is a very sensitive information which is not disclosed to the public, and when there is the person who tries to take benefit of the share market price speculation based on that sensitive information, then it is known as insider trading. So insider trading are actually banned and regulated by SEBI. Merger and acquisition helps in the merger and acquisition regulation. It helps in the regulating credit rating agencies, very important. It helps regulating the foreign portfolio. Sorry. It helps in regulating the foreign portfolio investment and e-governance initiatives. So these are the functions of SEBI, Securities and Exchange Board of India. So these are what? These are the functions of Securities and Exchange Board of India. So when we talk about the next, that is PFRDA. PFRDA is Pension Fund Regulatory and Development Authority of India. It was established in 2003. Pension Fund and Regulatory and Development Authority. This was established in 2003. If we talk about this body helps in promoting, regulating, and developing the pension sector in the country. If we talk about the National Pension Scheme, these were launched by PFRDA in year 2003, and then to all, it is extended to all citizens in 2009. And this come under the jurisdiction of Ministry of Finance. Now, what are the functions of this PFRDA, Pension Fund Regulatory and Development Authority? So first of all, it actually helps to regulate the pension fund. It actually protect the subscriber interest. It help in developing the pension market. It help in standardizing the pension product. It help in implementation of National Pension System, NPS, help in the financial literacy and education. They regulate the intermediaries. They encourage technology and digitalization. So these are some of the functions of Pension Fund Regulatory and Development Authority. Clear? So I have discussed about three important regulator. We have discussed about Reserve Bank of India, we have discussed about Pension Fund Regulatory Development Authority, and we have discussed about the CP, right? Still there are some regulators left. Okay, now let's talk about some of the practice question. Let's talk about some of the questions which are related to this chapter. First of all, in which year Reserve Bank of India was nationalized? Everyone please answer this question. In which year Reserve Bank of India was nationalized? Everyone, please answer this question, guys. In which year Reserve Bank of India has been nationalized? Everyone. So if we talk about the nationalization of Reserve Bank of India, 1st January 1949. Everyone. Yes, 1st January 1949, Reserve Bank of India has been nationalized. Nationalization means when Government of India took over the control of Reserve Bank of India. When Government of India took over the control of Reserve Bank of India, right? How many times at minimum does monetary policy meet in a year? Meeting was done how many times? Everyone. You can all answer this question. Meeting can be done in how many times? Everyone, please answer this question, guys. Meeting. Reserve Bank of India meeting can be done in how many times? Everyone. So at least 4 times meeting is done. Okay, 6 times, at least 6 times the meeting or Reserve Bank of India is actually maintaining the monetary policy. So it is actually for the regulation of monetary policies, but the meeting is done at least 4 times in a year. Right? Unit 28 of IEFS Module C, and that is reforms and development in the banking sector. Okay, so this is module C, unit 28, and this is the reform and development in the banking system. So we are going to discuss about this today, right? So let's start discussing this. Okay, the very first thing is the infrastructure financing. Okay, infrastructure financing, first of all, you all know that infrastructure is a backbone of any economy. Infrastructure development is very necessary for the development of any economy, right? So we have to develop, we have to do the infrastructure, right? Without infrastructure development, the development process is actually very slow. And obviously, providing finance for the infrastructure development is one of the very important thing that the banking industry need to do. So it required heavy financial investments as well as the benefits also. Okay. And if we talk about the very distinctive features of the infrastructure, is that first of all, building of infrastructure requires a very large investment. You are investing in infrastructure, so actually it requires very large investments, right? They contribute to the output after a very long period of time because their gestation period is quite long. Their gestation period is actually very long. Gestation means from the date it is started till the date it ends. So this gestation period is very long, and that's why it requires a very large investments, right? Second, their large overhead capital bulk investment, significant economies of scale are found in most of them. Okay, they have what they have a large investments. Okay, if we talk about they have invested, there are large investment in the infrastructure financing, and so they have the cost advantages. Okay, cost advantage that are reaped by the companies when the production becomes efficient, right? Last, they have are externalities. Externalities means they have cost or benefit that is caused by one party but financially incurred and received by another. I am making the infrastructure. Yes, I am benefited, but apart from me, various other people are also who are benefit from these infrastructure. For example, if there is any society or any building which is building, right? So beside this society, beside I am reaping the benefit of the profit of selling the flats there. There are a lot of others individual also who are benefited from that society. For example, there are vendors who are getting paid for delivering of the services, maids are getting jobs there, there are infrastructure development. So this is actually the externalities, means the benefit is not only to the individual who are building that complete infrastructure, they are reaped by the other individuals, right? So infrastructure, the three most important thing in the infrastructure. Okay, the first very important thing is they require a large investment. Second, they have the economies of scale because of the large investment. When each unit is sold, you will reap benefit of investment. Third, there are externalities. Externalities means what? Externalities means they have the important features, like their benefits are actually reaped by different individuals, right? Okay. If we talk about the next thing, channel of financing infrastructure in India. So what are the channels for financing the infrastructure in India? If we talk about the different channels which are actually for the financing of infrastructure, the first is the government. Okay, the first is government. Government providing infrastructure financing. Why? Because government think that obviously infrastructure development is one of the most important thing for the economy, right? So that's why the government is actually doing what? The government is promoting infrastructure financing by providing them funds, right? Development financial institution, one of the most and the very important institution which provide long-term loans, long-term financing to infrastructure. There are commercial bank also. There are commercial banks who are providing loans and financing to the infrastructure. There are different non-banking financial companies who are providing long-term loans and financing to the infrastructure. There are insurance companies and pension funds. There are insurance companies and pension funds also which are providing financing to the infrastructure. There are external commercial borrowings and foreign direct investments from abroad. These are all those who are providing infrastructure financing to the infrastructure, right? Now, what are the characteristic of the infrastructure financing? So, if we talk about the characteristic of the infrastructure financing, yes, there is a longer maturity. First of all, there is what? There is a longer maturity. There is the larger amount of risk, a larger amount that is involved. And due to longer maturity and large amount, there is higher risk. When you are developing any type of infrastructure, first of all, it requires a a longer maturity. If you are financing the infrastructure, you should be taken that it should be repaid in 15 to 20 years. Why? Because the gestation period is very long. Gestation period is from the date of commencement till it ends. This is very long, right? And obviously this requires large amount. And so when large amount is actually invested for a very long period of time, it is a very risky investment source. It is actually very risky. Clear? So these are the characteristics of what? These are the characteristics of infrastructure financing. Clear? Then everyone just please, whoever is watching this video, just please like and share the video to the maximum you can. Everyone guys, whoever is watching this video, it's a request that please like and share this video. Everyone. Done? Okay, next, if we talk about the development financial institution, so development financial institution is one of the most important institution which provide financing to what which provide financing to the infrastructure. So development financial institution, this is an agency that finances the infrastructure project that are of national importance and may or may not conform to the commercial written standards, right? So they provide financing to the infrastructure project. If we talk about the development financial institution, they provide long-term credit for the capital intensive investments. They provide long-term credit for those projects which are capital intensive investments and which spread over a long period of time, and this yields low return, right? If we talk about the development financial institution, these are also known as the development banks. Development financial institution are also known as what? Development banks. And these are different from the commercial bank in the term that commercial bank mobilize short, medium term deposit and let similar maturities to avoid the maturity mismatches. Okay, which actually, if we talk about the development financial institution, these are the development banks and they provide the longer term loan in the case of infrastructure. Okay, whereas if we talk about the normal commercial bank, they provide short to medium term loan in the infrastructure financing. Clear? Done? Okay, next. Now, if we talk about NAFID, NAFID is very important. Okay, NAFID, first of all, the full form. What is the full form of NAFID? NAFID is National Bank for Infrastructure and Development. National Bank for Infrastructure and Development. This bill actually was introduced in 2021 in Lok Sabha, right? And then the bill was passed, and according to this bill, the National Bank for Financing Infrastructure and Development, NAFID, was actually formed as a principal development financial institution for infrastructure financing. So this was passed as the principal development financial institution for the infrastructure financing. The main institution for the infrastructure financing is the development financial institution, right? If we talk about the NAFID, NAFID was set up as a corporate body with an authorized share capital of rupees 1 lakh crore. So it is set up as a corporate body and it is set up with a authorized share capital of rupees 1 lakh crore. Okay. Next, if we talk about the NAFID shares, okay, who hold the shares of NAFID? Who is responsible for holding the shares of NAFID? So, if we talk about the shares of NAFID, these are held by central government, multilateral institutions, sovereign wealth fund, pension fund, insurer, financial institution, banks, and other institutions which are prescribed by the central government. Okay, so National Bank for Infrastructure and Development shares has been held by whom? Shares has been held by central government, multilateral institution, sovereign wealth fund, pension fund, insurer, financial institution, banks, and other institutions which are prescribed by the central government. Now, if we talk about the NAPFID, initially the central government owns 100% share of the institution. Initially, the central government hold 100% shares of the institution, which may subsequently reduce to 26%. So at the initial stage, central government has hold 100% share of the institution, but now it has been reduced to 26%. Okay. If we talk about the NAFTA, National Bank for Infrastructure and Development, it is actually governed by the Board of Directors. October 2021, there was a banking veteran whose name was Shri K.V. Kamal, has been designated as the first chairperson of NAFID. He has been designated as the very first chairperson of NAFID. If we talk about the central government, they grant 5,000 crore NAFID by the end of the first financial year because it is the principal organization for the development financial institution. So obviously they need a lot of amount. They need a lot of amount. So approximately 5,000 crore grant was given by the central government for the establishment of this. Clear? If we talk about the function of NAFID, what are the functions of the NAFID? So, first of all, it actually extends loans and advances for infrastructure project. So, the main thing, the most important thing for the infrastructure, the main thing for the infrastructure is they help in loan and advances for the infrastructure project. They help in taking over refinancing of existing loan. They attract investment for private sector investor and institutional investor for infrastructure project. They help in organizing and facilitating foreign participation in the infrastructure project. They help in facilitating negotiation with various government authorities for dispute resolution in the field of infrastructure financing and provide consultancy services in the infrastructure financing. The main purpose of the NAFID is the infrastructure financing. They provide loan, they refinance the existing loan, they attract the investment, organize the foreign participation in the field of infrastructure, right? This is next. Very important is ease. First of all, the full form is ease of access and service excellence. Ease, full form is very important. Ease of access and service excellence. The main objective behind setting up ease is to enhance customer experience. They help to promote the digital banking. They help to improve the governance and responsibility, right? So for providing customer with a very better experience for improving the governance of the bank, ease of access and service excellence has been established or formed. What are the key components of ease? There is digital transformation, there is simplified processes, there is customer centric approach, transparent governor, there is a strong compliance, and there is risk management. So these are the key component of ease. Implementation and monitoring, they follow a reform agenda which regularly helps to improve the performance. They helps to the in the performance assessment, which actually help to improve the performance, right? In potential impact, if we talk about the potential impact, yes, they help in increasing the banking services, they help in building the trust, contribute to the financial inclusion. Because see, if you are providing customer with a better experience and services, obviously your banking services will be enhanced. Okay, you will contribute to the financial inclusion, you will align yourself with the global standard, right? Now, if we talk about the next thing, ease version. So ease version is, there are different version of ease that has been started, right? Ease 1.0 2018, which focus on the customer responsiveness, which focus on the responsible banking, credit quality, MSME support, financial inclusion, and digitalization. 2.0 version started in 2019, which help in data analytics, grievance readdressal, tech-enabled banking. 3.0 version 2020, it has been started. It help in the smart lending, enhance customer experience, help in optimization, banking collaboration, performance scoring. 4.0 2021, help in the digitalization, process optimization, workforce management, grievance readdressal, and banking reform index. And 5.0 2022, this help in small and medium enterprises lending, regulatory collaboration, export credit, governance, continued reformed agenda. So these are the different E's version: 2018, 19, 20, 21, and 2020. Clear? So these are the ease version. Now let's talk about some of the practice question. Everyone who is watching this session, if you have any doubt till now, please ask your doubt. If no doubt, just please give me a thumbs up so that we can start the practice question. Done? Can we start the practice question? Everyone. Okay, so the very first question is, which of the following are the characteristic of infrastructure financing? Which of the following are the characteristic of infrastructure financing? If we talk about the characteristic, there is a longer amount, larger amount, longer maturity, fixed and low but real rate of return, and all of the above. What are the following characteristic of infrastructure? Everyone, please answer this question. Following characteristic, what are the characteristic of a infrastructure? What are the characteristic of the infrastructure? Larger amount, longer maturity, fixed and low real rate of returns, or all of the above. So the correct answer is what? Okay, so the correct answer is yes, D is correct answer, all of the above. They have the larger amounts, longer maturities, and fixed and low real rate of returns. Okay, next. What is the authorized share capital of NAFID, National Bank for Financing Infrastructure Development? Authorized share capital. What is the authorized share capital of NAFID? Everyone. Authorized share capital of NAFID. What is the authorized share capital of NAFID? So if we talk about the authorized share capital of NAFID, yes, 1 lakh crore. 1 lakh crore is the authorized share capital for NAFID. Okay. Third, smart lending for aspiring India is one of the theme in which edition of EASE? Which edition of EASE has this theme? Everyone. Which edition of EASE has this theme?